All right, hey all, we're just gonna get this kicked off now. So, change up the stream setup a little bit. I'm actually doing this off of my iPhone. Hopefully, you guys like this a little bit better. I think it's a little bit cleaner. You can tell that the hold on, let me. It might be an echo here. Let me just double check, but I'm not double. Apologies about that. Yeah, I think that's what it is. So let me mute that. We're good. So awesome. Hopefully you guys can hear me well, and hopefully you guys enjoy the setup a little bit more. During the daytime, you can actually get a better view of what's outside on the patio. I used to be streaming this in the kitchen, but had a good conversation with Kyle the other day from Passive Income Investor, and he said that this lighting here is a little bit better. Wasn't sure if it was exactly um, wasn't sure if it was exactly the camera that I was using off my iPhone or if it was actually just the light that's right above. But anyway, want to talk about the portfolio and want to talk about what I'm doing, and obviously want to hear from you guys as well. I think a lot of you guys are still trying to get up to speed with what your investing strategies may be, and so want to use myself or as well as Len Kyle. Don't want to speak for him as well, but I think both of us are more than happy to sit with you guys and help you guys understand what your investing strategies are, what works for you, what might not work for you, what you've tried in the past, and maybe just to be a sounding board if you guys ever want. I know from personal experience, investing is a topic that some people aren't really interested in talking about. Some people think investing in the markets is a bunch of, I guess, smoke and mirrors. And then I think you have a group of people like ourselves that are interested in it, which is why we have such a great community here on YouTube. But I think if you just talk about it in normal everyday life, I think a lot of people kind of get turned off from it. So um, I understand that, which is why I kind of started the channel on its own, and actually have been gracious enough to find a lot of you guys in the community here that have kind of linked up with us. But I think we all share a similarity in you can't talk about this stuff with friends or family sometimes because they're not really interested. Their eyes kind of gloss over. They think you're trying to sell them snake oil. Who knows? But anyway, more than happy to have any of you guys really jump on the stream, or if you just want me to continue to ramble on, that's perfectly fine as well. I don't mind. Just trying to make sure that everyone's set up here. If anybody wants to join us here, appreciate that the camera's wobbling a little bit here. But yeah, so a little bit about myself for those of you guys that may have just been joining in. I recognize that the channel has grown pretty substantially over the past 2 months or so, probably about 100 or 1,000 or maybe 1,500. So appreciate that some of you guys might be new chiming in. Some of you guys might be finding this link from the WhatsApp group. Some of you guys might be finding this from the Facebook group. And if you're not a part of either of those, I have it in the description, hopefully for you guys to join if you guys are interested in that. But a little bit about myself. So I'm 28 years old. I work in the oil and gas industry as a petroleum engineer by education, and currently live in Trinidad and Tobago as an expat. So I do know a little bit about the oil and gas sector. I don't know everything, obviously, because I don't run any of these companies. I just work at them. But it's what I deal with day to day on a good basis. So if any of you guys are interested, I know some of you guys have kind of stumbled across the channel and specifically dived into that oil and gas niche and really just want to ask me a lot of questions on that. That's fine. I do already have some content about whether or not you're going to invest in, say, oil sector ETFs or oil futures ETFs. I already have some videos about that if you guys are interested. But a little bit more about me. So been building the portfolio now for about, I would say 7 years. So 2013 timeframe is really when I started working full time. And so have been building the portfolio off of that. And so this isn't some sort of, I guess, get rich quick overnight sort of story with respect to my particular portfolio. It's been more of a get rich carefully, get rich conservatively sort of aspect of getting the portfolio off the ground. It's been saving anywhere between 25 to 50% of my income on a daily basis to try to continue to grow the portfolio. And so I landed personally on dividend investing, and there's a bunch of reasons why, and we can talk about that in the future. But anyway, a little bit enough about me. Appreciate that there's quite a few of you guys already in here. I can't really see. thankfully, somebody near and dear to me actually dropped me a 99-cent sticker, so I appreciate that. That means the world. Curious, where is my number? Sorry, and I'm trying to get this new setup here. So we got about 21 of you guys in here. Actually, let me move this over to here. Maybe it helps out a little bit, so I can see a little bit better. But and adjust this camera quite a bit. So yeah, I'm more than happy to talk about whatever you guys are interested in. If any of you guys want to hop on the stream as well and just have a quick conversation about maybe where your portfolio is at and what you're thinking and what your thoughts are. I think one of the main questions that I get recently is, do I think the market's going up or down? And I honestly think that you can't predict, right? And so a lot of people always ask, oh, I'm holding off in the market. I think it's going to go down 30, 40, 50%. And I think one of the things that you should do is really just look at the past 6 weeks, understand what you've done in your particular portfolio, and whether or not you would grade yourself a 100%, an 80%, 70%, 60% over what you've done over the past 6 weeks. I think a lot of people have been waiting for something like this to happen over the past 11 years since the last Great Recession, which was in 2008, 2009 timeframe. And I think a lot of people had strategies in their minds about what they would actually execute when something like this were to happen again, when the market were to unfortunately dip back into correction territory and even bull market territory when it did in the middle to end of February. And so I think that this warrants some time now that the markets have recovered slightly and we're down between, I would say, 10 to 20% from all-time highs, whether it's the S&P 500, the NASDAQ, or the Dow Jones that you kind of read things off of. We got a bit of a breather with this recent bull run coming from the middle of March to now. Of course, the last 2 days have kind of trimmed off about, I'd say 2.5% to 5%, depending on what market index you're looking at. But regardless, I think this gives you an opportunity to sit here, reflect, think about it for 10, 15 minutes, something as simple as that. And you'll be able to understand how your performance is. Are you doing well compared to what you thought? Did you think that you were going to be investing steadily over the time that the market was continuing to go down? I personally rated myself when I had this conversation with Ryan from Ryan from Independent Investor. I gave myself about an 80%, and I think it was because I almost accelerated too much on how much I was investing over time. And so for me personally, it was, I think I did well. I had been investing since 2013, so I had a lot of time to think about what I would do in terms of what would happen if there was some sort of upcoming recession. And the groove I've kind of got into over the past, I guess, 3 years, I'd say, as I was kind of ramping up for this sort of recession or volatility in the market, was that I was going to, no matter what, consistently invest into the portfolio on a bi-monthly basis, so twice a month. So every time I get a good paycheck, I would be continuing to invest. And so what I would then do is have hopefully a decent amount of cash on the side and inject those larger amounts of cash into the markets when I believe that they were relatively good prices. And so another thing that I had done in my 401k was, fortunately or unfortunately, for the past 6 months to a year, I've had some of it in cash because I have thought about rolling it over into a individual retirement account, whether it was a traditional or whether that was a Roth IRA. And so I did miss out on a little bit of gains from that, but fortunate for that, I was in mostly cash in my 401k for during this recent volatility. And so once we started getting down to about 15% down from the recent highs in late February, I was starting to add about 10 to 15% every time it went down. So 15% I did an injection, 25% and I did another injection of about 10 to 15%. And so I had it scheduled all the way down to 55 to 65% if we were to get to that level. So unfortunately we didn't. So I ended up only investing about half the funds in the 401k and the other remaining half is in cash. But it just goes to show you, if you kind of systematically think about these things, where you can be. And before I checked, it was on Wednesday or Thursday when I checked, the 401k was actually up 5% for the year. So that was just lucky timing, I think. Now, of course, I think we had a pretty rough day on Friday, so it might not necessarily be up 5% anymore. But I think it just goes to warrant and show you still what you can do with the portfolios if you manage them appropriately and you think about things appropriately. I've heard stories over the past 6 weeks of people selling once their portfolios dipped down 40%, and they said, well, I'm going to wait this out. And then the next 2 months, obviously, since then, they've recovered by about 25 to 30%. And so now they're sitting in cash, losing physically the 40% that they had basically invested and not recovered any of that, just because they are being skittish. And I can understand that. There's emotion with seeing a dollar value go down. But I think you just need to understand what you're invested in. If you think what you're invested in is something that's truly good and hopeful, then that's something you need to stick with. I'm not saying that if you unfortunately made a wrong mistake, like investing in, let's say, an airline recently or something else that may have been in a market that, obviously has been unforeseen, that was going to be, hitting turmoil over the last 6 weeks. It might be worthwhile to save some of that cash, sell out of some of those positions, and invest them in something that you think does have the benefit of going up in the long term. So, honestly, I think that what a lot of people do in these sorts of situations is they'll get excited. They'll continue to invest because things are going good. And I think Kyle does a really good job about talking about this. And he's mentioned that everyone thinks that they're a stock market guru when the market's in a bull run and everything's going up and to the right. But of course, things start to hit the fan when you don't have a strategy when the market goes down. And so I think what a lot of people do is they don't understand fundamentals. They don't understand where their strategy may lie. And while in a bull market, that might be okay and that might work, when you start having the opposite effect and you might actually start having a bear market, it really starts to show who actually has planned for that, and what that might actually happen to your portfolio is you sell at the wrong time for no apparent reason other than you want to conserve cash when at a historical pace. How rare is it that the market stays depressed for 40% for an extended period of time? And so yeah, that's all I'll really talk about with respect to that. I guess with respect to my portfolio and what I've kind of started investing in over the past, I would say 6 weeks or so. So I invested heavily into financials. And granted, I think I recently did the quick calculation, and I invested about 48,000. So that's not 48,000 brand new into the portfolio. Keep that in mind. Some of that might have been in savings. And so I converted it from, say, savings where it might have been sitting in, let's say, an emergency fund, which I would consider part of the portfolio, and now has since been invested. So granted, it seems like a lot bigger than it was, but I would say maybe half to 3/4 of that might be new capital. The other portion of that was obviously already sitting in a savings account. But regardless, a lot of that has gone into financial stocks. A lot of that has gone into industrial stocks. I'm trying to think what else. A little bit into real estate, but not so much because I was pretty heavy into real estate beforehand. But I would say mostly financials and mostly, definitely mostly real estate. And actually, if I have a moment, I can actually take a quick second and pull that up. And we could actually take a quick look at what I'm actually referring to. And we can share that on the screen for you guys if you guys wish, and we can kind of walk through. And it might not be completely up to date, but it'll look pretty cool, and it'll be something we can talk about. And if anybody eventually wants to hop on and kind of discuss what they're kind of going through and what I might be thinking and what my experience is, I would be happy to go about doing that. So just give me a moment while I get all this prepared, and we can go forth and be merry. So let me get back onto StreamYard here and share my screen. Okay. So first it's going to show up as screenception, so I appreciate that. All right, very good. Cool. So this is obviously what I generally utilize to track my investments. So a lot of you guys are familiar with that. So I changed it to be specifically the investments that I've kind of looked at and invested in over the past 6 weeks or 6 weeks or so. So appreciate that. It is a little small, so I can increase the size a little bit. But I think it's relatively cool to be able to understand and see everything that you're doing. So where you're investing by specific account, what specifically you're looking at by sector and stuff like that. So that way you can get a good idea as to what's going on and are you investing across all the different sectors. So you can see I did make quite a bit of energy investments as well. So it looks like specifically we'll kind of run through it quickly. About 21% energy investments, 34% financials, 13% in terms of real estate, a decent chunk in industrials, some information technology, and ETFs is starting to get a little bit bigger as well. But I also did make a decent position here in telecommunications as well. So nice little 3% chunk. I believe that was an AT&T. But the cool thing is that you can see here is how much I've increased the income. Now, of course, some of this was in Shell and some of it might take a little bit cut off. But you can see that about 3,000 increase in the portfolio just from these investments over the past couple of months alone, which is nice. Granted, some of it was in Boeing, so that some of that will get trimmed away, and then some of it was in Shell, which I know some of it will get trimmed away as well, which is fine. But I did just do a recent look at how much has kind of been trimmed away, and compared to the market volatility that we're seeing, you are only really losing, I think it was like 5% of the value of the portfolio at the moment. And so, sorry, not value of the portfolio, of the income, I'm sorry. And keep in mind that at one point we were down like 40 to 45% from all-time highs. And so if you think about it on a holistic basis at the moment, and I know there is some sort of lag associated with the income versus what the value of the portfolio looks like through time. And we saw that in 2008, 2009 as well. We started seeing a kind of lag of companies starting to cut dividends in 2009, 2010, and then a little bit in 2011 as well. So I anticipate some of that will continue to go on as people run out of cash, and if this sort of volatility in the market continues to persist over the long term. But I think as of right now, considering some of this is some of the most dire pieces that we've seen over the past long while, maybe even in history, people are legitimately having to shut their businesses, not because of, say, credit facilities drying up like they did in 2008, but because obviously, one, they're not allowed to be even open. So relatively interesting in that perspective. But I think over time it'll continue to get better. But just looking specifically at some of the positions I may have initiated, and I don't think it might not include some of the ones that I just did in early May, but that's fine. But you can see there's a lot of green on here in some of these middle sections. There's some reds at the very tippy top, and that's fine with me because I plan on holding a lot of these for the long term. So what we can do is kind of look at the previous. So in the beginning, it was a lot of U.S. Bank, Wells Fargo, some BP, some Shells, some Bryn Mawr Bank Trust, some Caterpillar, some 3Ms, some Exxons, a little bit of Boeing in the 160s. And I continued to invest in Boeing as it continued to go down. And if it continues to go down, I will continue to buy as well. Some GEO Group added to that a little bit as well. Some Stag, Caterpillar again. Some Southern Company is one I've been continuing to try to add, and some Realty Income Corp as well. Visa, I wish I bought more of this. I only bought 20 shares of Visa at about 136 bucks. Wish I had bought more. Wish it was a 100 share position, but it is what it is. But yeah, relatively cool. You can see, obviously, pulls the dividend dates and everything for you. So excited about that aspect of things there. But let's just hop back into the StreamYard. Let's see if we have anybody that wants to join us here. So looks like it's about 46 of us at the moment. We do have somebody that does want to join. He doesn't have any devices connected at the moment. So I don't know if that means he does or does not have a microphone on there. It doesn't look like he does. But once you get a microphone on there, Sebastian, I'd be more than happy to bring you on. But let's just hop through and see if I can answer some of these questions for you guys. It's been going about 20 minutes. So hopefully we can check some of these questions out and let's see. So it's just somebody that wants to ask a private question, doesn't necessarily want to be on the stream. So a gentleman here named Sebastian, let me see if he wants to get on here. Do you want to get on or just ask a question? So he asked, hey, from Sydney. That's awesome. From Australia. That's cool. Appreciate that. That means a lot that we have people watching this from different continents. That's pretty crazy, especially middle of the day there. I was actually watching a live stream of somebody from Melbourne has a live stream on YouTube. So that's pretty cool. What do you think about airlines now that Warren said he had sold everything? So for me personally, I'm not really a big guy in airlines anyway. So for me, I think I invested in, I want to say Spirit Airlines back in 2014, 2015. And I didn't experience any negative, I guess, volatility in investing in Spirit. I just didn't think it necessarily went anywhere. But I think that all in all, it's a very cyclical business. And I honestly don't view it as something that is easy to invest in, one. And then two, there's a lot of moving parts for me that I don't necessarily understand. So I don't understand the marketing aspect of airlines. I don't understand 100% how they make their revenue. I mean, of course, people flying, that's how they make their revenue, but how everything's split up, how their margins can go up and down so quickly. And of course, they're also somewhat related to commodities as well. So if you think about it, the price of oil and gas does impact what the business margin for airlines might look like. And so I also think that they do have a lot of external factors on them as well. So keep in mind, like when things went south with Boeing, obviously, with some of those crashes. Yes, some of that was obviously Boeing, but some of it could also have been operator error as well. And so sometimes, it can hit multiple stocks just from one incident, one crash, whether that is specifically the 737 incidents that have happened over the past couple of years, or whether that is just an airline going missing that we've seen in the past, or somebody accidentally crashes a specific airline and that ends up meaning somebody ends up with a big liability. And so, but I think you could say that about any company, to be 100% honest with you. You could say that about any industry as well. And so I think what it is it's not a business that I can wrap my head around all too well. I'll utilize airlines personally, but I think in terms of them being large growth stocks and actually having consistent dividend payments, I think is troubling for me. And I don't see them continuing to grow. I mean, the way I view it is United has already grown as a company. And so I don't think that it's going to expand massively over the next 2 to 3 years or even 10 years. And same with, say, Delta. I don't think that Delta is going to be a company that grows its bottom line by, billions upon billions of dollars. Maybe not bottom line is not a good term because obviously at the moment things are getting very bad. But in terms of growth of travel over the next 10 to 15 years. I don't think it's going to go up, say, circa 8 to 10 to 20% in a given year. Maybe in 20 to 2021 because of the downturn that we're seeing, and flights are down about 95%, or at least volume is down about 95%. Just based off what I've heard. I've not done any full research other than what I've heard, but yeah, I don't have an answer for you, to be 100% honest with you. I personally felt vindicated when I saw airlines go down. Not that I want to see anybody lose money, or not that I want to see companies suffer, because I do utilize United and other companies as well, but for flight and travel. But I just don't understand how the margins work for airlines, and so it's just a company I'm gonna stay away from. So thank you. So Sebastian, hopefully you can share the channel with some of your other Australian friends. You're not alone there in Australia. There are a few of you guys, so appreciate that. And we do have pelt work in here as well. And so what I am going to do, though, is just double check some of these comments that I didn't miss anything, and then we will get pelt work on here. So let's see. Lived through the Great Recession here. Let's see. What else we got? So yes, I am down for a Houston meetup once I do have an opportunity to get back to Houston. Unfortunately, I'm not coming back to Houston this year full time like I was anticipating. I'm actually going to stay here in Trinidad another year. So hopefully you guys aren't too upset with that. For some of you guys, I know there's quite a few of you guys that are Houston enthusiasts and live in Houston and are all about Matt Money Channel. So I appreciate that. But yes, I do plan on being there. I do have my home base as Houston. And so I do have to go there a couple times a year just to keep up with people, make sure they don't forget about me. Obviously, that's number one, to make sure I just keep in touch and just to catch up with friends. So I'm going to try to get there as soon as some of this, the travel restrictions go down. Actually, there's no international flights at the moment out of Trinidad back to the U.S. And I think that it's that way. Last time I heard, it was until July. So fingers crossed that something comes back in August or something like that, because I do want to come visit family, because it's been since Christmas time frame since I've been able to go visit them. So we got our boys in here. We got Dave from Hidden Freedom Investing, Jason. We got All Good, obviously. I saw Kyle from Passive Income Investor, so welcome to you guys. Always appreciate your guys' support here. And just trying to understand and see where you guys are at. So I think that I don't see many questions for me. What I'll do is I'll try to keep them down at the very bottom. And I will try my best. But I'm going to add pelt work onto here and see what's going on. Hey, pelt work, how you doing, sir?
Hey, how's it going?
Good, brother. Can you hear me okay?
Oh, definitely. Had to turn the YouTube off, so I don't have you in stereo. But yeah, so I just started getting into this in September, and I've been following Ryan around, and then more recently you, as well as Passive Investor Channel.
Okay, cool.
So yeah, basically I have been trying to do about the same thing I hear you've been doing, where just you get paid every 2 weeks and you take a certain portion of it. In my case, it's $200 each. And what I'm wondering is how do you divvy that up? So what I started doing was I started out doing foreign investments with a ETF, and I said right from the start, Ryan's like, yeah, pick your goal, no matter what happens, finish a goal, go on to the next thing. So even with this bouncing up and down and whatnot, I decided to lock into that, and I was going to get 100 shares of that, which I have now done. Which it started at 38.39 when I first started, and unfortunately it started just going up really fast. So in January it was trading around $44-$45 a share. So I was like, oh great, because I wanted to try and get in at 38 to 39 average before it moved. So I was kind of racing the clock because I was racing against some foreign events that I knew were happening. So and then this all happened, and it went down to $28 a share, and I was able to complete it, the last third of it, which actually brought my dollar cost average down to 37.5.
Cool.
So I'm extremely happy with that. I'm still down about $600 total, but for the most part, I think it's going to come back up in the future. And then, so now I've started, what I would do is I would take that $200, buy up however many shares I could, and then I was dumping the remainder off into SWPPX, which is basically Charles Schwab's version of VOO.
Okay.
So that's up to about 150, and then there's another one, SWLGX, which is the same type of thing, but it's their large cap. So whichever one is lower, I've kind of been boosting that up. So between the two of them, I've got about $300 in that. And then what I've been doing recently, watching Passive Investor Channel and you more with the dividend, my original goal was to just dump everything into ETFs. 70% they say domestic, 20%, which right now my international ETFs are about 70% because I started to go with those first, which was actually probably a good idea. But anyways, and then you do the 10% for I'm forgetting the name of them now. What are you supposed to have for 10% of your portfolio?
Very dependent on who
CDs and stuff like that. The super safe stuff. I haven't gotten anything in there yet. But anyway, so now what I've been doing is I've been kind of inspired by you guys with the whole dividend investment. So I went through, watched a bunch of your videos, Ryan's videos, and put together a list of 20 independent dividend paying stocks.
Right.
But the problem with those is, how do you determine which one you want to invest more with? Do you want to do like 2% across all 20 of them for 40% of the portfolio? And then like with investing $200 per week or per every other week, how do you pick which one to do? Because obviously some of them are $30. I just bought my first share of Home Depot, which was like $217 when I got it. So that's kind of like, how do you determine which ones of those you want to invest in as you're building this up over time?
For sure. No, first and foremost, congratulate. How old are you? Did you mention that?
43.
43. Okay.
I'm starting later in life. I don't.
No worries. You're starting way before retirement, so that's all that matters, right? I have people. Sometimes they ask me, they're like, "I'm 2 years from retirement. What do I do?" And I'm like, "Oh God." It's like, go back in time and hopefully start a little bit sooner.
Yeah, with my job, I actually hope to never retire. If at all possible.
That's good. No, that's a phenomenal answer. As long as, I mean, so I guess what your goal is. So I generally talk about 5 things that I generally look at. So when people ask me like, what do I do? So you already answered the one, which is hopefully get some income up. And so you don't want to retire. So your time horizon could be anywhere between now and what it is, whatever you want it to be in the future. But what I generally ask people is, one, what your objective is, which you've kind of already answered, your risk tolerance, your time horizon, how active and passively you want to be doing all this, and then how often you're contributing. So you answered a decent amount of those. But I guess my main question would be, is what exactly is the objective? Is it to just get dividend income? Or is it just have some extra money on the side, so I can just try to help frame the answer?
100% for retirement. So when I say I never want to retire, it's basically like this whole storm. I've been in quarantine for the past 2.5 months because I do IT systems admin, so I can do everything remotely. So I don't ever have to leave, honestly, which is awesome. But the thing is if something were to happen in the future, you don't want to be tied down to, okay, well, careers change or something happens in the future, unforeseen, COVID, that does come up where, okay, now you do have to retire. Like say you get in a car accident and are paralyzed or who knows what. So it's kind of like, if something were to happen, say when I'm 65, 70, somewhere around there, then I would have the income to be taken care of. I'm not looking for anything now, in fact, except for that company that is making the COVID remdesivir treatment. I invested 3 shares in that company, Gilead, I think last couple of days. That was 200 and something. And of course it went down right after investing it, but that's how that always works. But for the most part, it's way in the distance. Everything that I'm doing right now is inside of a Roth IRA that I started. So
yeah. So let me ask you a question. So you work in IT, so I don't want to ask what your income is or anything like that, but I guess my main question would be, is how much are you saving? So you said 200 a check, which is a
It's
great
about
start.
it's about $400 every 2 weeks.
So 400 every $2 or
No,
every
I'm
2 weeks.
sorry, $200 every 2 weeks. So that would be $400 a month.
Okay, so 400 a month. How much of that is, I guess, around what percentage of that is your income? Is that 10%, 20%?
It's a little bit less than 10%.
A little bit less than 10%. Okay, so
Because I've got this going on, then I've got the maximum from the Roth or from the 401k at the company. So figured out
hell
what
yes.
they would
Okay,
match up to.
so
So
that you have that as well. So
that's been
you're
running
talking
for the
about,
past couple of years.
you're talking about 10% for specifically
Take home.
your outside of 401k investments.
Yes.
Okay, and how much are you around? What percentage are you contributing to the 401k?
I believe it's 6%.
Okay, so you're up to like 16, and then is the company matching 100%, or are they matching?
No, they match 3.5, I think is where they max out at. So it's about 9.5%. That's been going for the
Okay,
past
cool.
4 or 5 years.
So you're getting close to 20%, which is good.
Yeah.
So there's a really good chart on there, and this is actually Mr. Money Mustache. So before we kind of dive more into a little bit some of the other questions you had, which I didn't forget about, so I'm not trying to divert from that. But a really good article that I like to put people onto is the one where it's like the simple math behind early retirement by Mr. Money Mustache. Have you read that blog before?
No.
Okay, so that's a really good one. So it talks a lot about trying to retire early. So it talks a lot about if you're only investing, say, 10%, and you're getting a 5% return after, let's say, inflation or what have you, it'll take you 50 odd years to retire. If you do 15%, it'll take you 40. If you're saving 20%, it'll take you, I think it's like 30 or something like that. But like a good sweet spot would be saving like 50 to 60%, because that narrows it down to below 20 years, and you'll be able to retire a lot faster. So it kind of just shows you like the exponential growth. And obviously, if you're saving 100% of your salary, you're technically financially independent, right? So, or if you're saving 90%, I think it was like 3 years. So it just kind of shows you the trend line, right? So obviously, many years if you're investing only 5 to 10%, and very few years all the way to, I guess, retired already if you're investing 100% of your income. So that's a really good one to look at to try to understand, are you saving too much, too little? But going back to your actual questions, which were specifically around investing specifically into individual stocks. So I don't know what platform you use at the moment. Do you utilize
Schwab?
Fidelity? What's that?
Schwab.
Schwab? Okay, so you use Schwab. So there was something on Fidelity in the past, so I'd be curious if the same product is on there for Schwab. And there's something that M1 Finance does, and I'm sure you've heard a lot about that as well. But it allows you to kind of build your own ETF. And what they called it on Fidelity was motifs, MOTIFS. And what it allowed you to do was kind of set up, I want to invest in these 20 stocks, and I'm going to invest $200 every paycheck, like you mentioned. And it would evenly split up that 20 stocks into $10 investments, and it would invest partial shares into those 20 investments. So that would be like the optimal scenario for you, right? Because at the moment, what you're looking at is putting $200 into this stock, putting $200 into this stock, putting $200 into that stock. And that's just taking you 3 different 2-week time periods, right? Because you're doing this every other week. Mm-hmm. So I would look into that as well, because M1 Finance is perfect for this, because I know they still let you do this. And if you're curious about that, there's some videos all over YouTube. It's a huge YouTube favorite. But that allows you to kind of just set up an individual ETF. And I'm sure Ryan has talked to you about it. Question, when you say Ryan, do you mean independent investor?
Yeah.
Okay, very good. Yeah, Ryan's a good friend, and he's quality. So always listen to Ryan's advice. He's
and then there's the other one that I'm trying to remember his name, that I've started watching like last month. I think so. He's got the really spiked haircut, and he's the magician.
Yeah, Kyle's a good friend of mine as well. I met up with him in Toronto, and him and I actually have the spreadsheet that I was kind of playing around with a little bit earlier. If you were watching, him and I actually built the website. Well, he built the website. I just provided the product, and him and I kind of run that and make sure people are happy and getting good use out of that. so yeah, he's a good one as well. I'm sure he wouldn't mind talking to you as well. But to answer your question specifically, more around how do you choose what companies? Because I know you wanted to talk about that as well. So you might have a list of. Sorry,
I
go
can
ahead.
pull up and let you know what my list is.
For sure, for sure. I mean, we can dive more into that as well. I don't mind that. But while you're doing that, I'll just pop off and kind of say what I was thinking, which is it really is dependent on what you're investing for. So if your investments are for dividend investing and not necessarily for growth, because you're looking for income in the case of, let's say, you have to, I guess, be into forced retirement, which I understand that, and I relate heavily to that because I work in a pretty cyclical industry as well. So um, in the case of, let's say, what the kind of scenario we're in with the macroeconomic trends in oil and gas, there's always potential for furloughment or unemployment. So that's why I generally invest in these dividend paying companies. So that way I have that income to potentially fall back on if need be. So I understand with your objectives. What
Exactly.
I generally look at for those kind of companies, if I'm looking for dividend paying sort of companies, is a lot of people look at payout ratio. And payout ratio is a good quick check because earnings per share is generally something that companies always report. But what earnings per share does is, unfortunately, it takes into account one-off tax items sometimes as well. So take, for example, Berkshire Hathaway is a really good example of this. Berkshire Hathaway in 1Q 2020 is going to lose 50 to 60 billion dollars on an earnings basis. But granted, Berkshire Hathaway is making massive amounts of cash, and they're not physically losing any of that money. It's just paper losses. And so what I mean by that is the value of the positions that Berkshire Hathaway owns, because they own, I think, close to 250 to 300 billion dollars worth of stock. They obviously depreciated in one Q like everybody else's portfolio did. And so they have to report that, unfortunately, on their books. So even though they didn't sell those positions, except for the airline positions, they did sell that. They have to carry that in. So even though they made massive amounts of money from, say, Dairy Queen, Precision Auto Parts that they have, let's see, Berkshire Hathaway Energy Company that they have, they made a crap ton of cash flow associated with that. They still have to report those numbers on their books. So if, say, Berkshire Hathaway was paying a dividend, people would look at that and they would say, oh my God, the payout ratio for 1Q was over 100%. It was, crazy. But at the end of the day, they're still not technically losing money because, one, they didn't sell the stock, and then two, the cash flow that still came into the business was massive. And so same thing with like banks and stuff like that. So a lot of what's happening right now with banks is they're showing these like negative earnings per share or smaller earnings per share. And so when you look at some of these bank stocks, they're going to show up as massive payout ratios. There's no way they can sustain the dividend for the long term. But what's not taken into account is a lot of that is just reserves. It's not actual delinquency notes or anything like that that's actually hit the books yet. And so what it is it's almost like these accounting measurements that are being regulated into some of these things. So while JP Morgan has accounted for, say, $8 billion in losses in the first quarter, they didn't actually lose $8 billion. Some of that was just, and most of it was actually just reserves. It was just like, hey, we're setting this aside in case something gets bad. So in actuality, JP Morgan made, $8 billion or so, and on an income basis, they said, well, because there's potential for you to lose some of that because of your modeling and what have you, in good faith, you have to kind of take that off of your books. And so what I'm basically trying to get at is payout ratio can be manipulated. And especially if you look at real estate companies and stuff like that, they have a lot of depreciation in the business. And so they can write that off for tax purposes. And so then, unfortunately, when you look at some of these things, they're like, you can't pay that dividend off of a payout ratio. So how are they paying the dividend? what I'm basically trying to say is this: cash flow statements are probably like the biggest thing that you can look at, because it actually shows you what kind of cash is actually coming into the business and is not being manipulated off of like depreciation or one-off tax items. It's basically your earnings before interest, taxes, depreciation, amortization. So like what your revenue was, what your cost of goods sold were, and what like your basic expenses are to like operate the business. That's like it, right? So if you make something for $100, you sell it for $200, and you want to pay yourself $10 per unit, then your revenue is $200, but your net income, I guess, would be let's say $90. It's that $90 that actually enters into your cash flow statement. Now, after you like have to pay taxes and all that junk, that's when it starts to get a little bit tricky, and I think that's what dilutes the message a little bit. So what I would just be cautious of is when you look at these companies, look specifically at cash flow statements. Don't necessarily look at earnings. Earnings can be heavily manipulated. Gotcha. So I know I went off on a big tangent. I would love
that's awesome. So,
I'd love to look at your stocks that you have in mind.
Okay, so I currently have one share of each of these that I have now because I'm still on the building stage. So I have AT&T, AppV, Delta, ExxonMobil, General Mills, Home Depot, Pfizer, Royal Dutch Shell, SWPPX, SWLGX, and Southern. And then the ones that I'm still looking at getting into are Caterpillar, Chevron, Johnson & Johnson, Coca-Cola, Procter & Gamble, Verizon, Dominion Energy, IBM, Qualcomm, Pepsi, and Waste Management.
Okay. So a lot of those are good stocks. But my question to you would be, why do you want to invest in those companies?
Because those are the ones that on all three of your channels I've seen recommended. Combined between all three of them and a couple others.
So I appreciate that. But at the same time, what I would I appreciate one that you're looking and watching Kyle, Ryan, and Mai's channel. That means a lot, of course. But the problem that I have is unfortunately, and luckily you stumbled across our channels, right? Because there are some folks out there. I'm not going to name names as much as people in the comment section might want me to. That you could stumble across and choose the wrong stocks, which a lot of those I thought were good ones personally, but some of them are very debt-ridden stocks that I wouldn't necessarily recommend. But one of the key things that I want to make sure that you potentially keep in mind is when you invest in some of these stocks, you might have to read their earnings reports, and you might have to dedicate 30 minutes to an hour at a minimum every single quarter to understand what is going on with the company. Are they doing everything right? What can you potentially do to make sure that you're falling in line with what they are predicting for the future of the organization, as well as are they doing everything that you expected, right? Did you have a thought process that you thought they were going to follow and the company actually went a different direction? Because it's a two-way street, right? I mean, the company's going to say they're going to do one thing, and unfortunately what they're doing during earnings reports is communicating back to you what actually happened. So, I think when you invest in those individual positions, you have to dedicate time to those. And sometimes if you know a little bit about the company, it just can take, after you kind of get familiar with them, it can just take like a 5-10 minute scan every couple earnings reports, and you can just be like, okay, yes, they're meeting their expectations. They're going up, 6-8%. That's what I expected. Don't expect anything else. So you can move on, and it can be something as simple as that. But what is nice to look at in some of these companies is their cash flow statements. And that's what I would look at most personally, and their balance sheets as well. Because for instance, what I'll take is Delta Airlines, because I have done a decent amount of looking at some of the cruise lines and airlines. While I don't generally invest in those sorts of companies because of the reasons that I mentioned when Sebastian asked me that from Australia just a moment ago, is I was looking at them for a swing trade. Now, I don't swing trade often, but when I see an opportunity, sometimes I dabble. And I did actually dabble with Carnival and Royal Caribbean and made like a 30-40%. Shout out to my boy Stevie. He's the one that was like, hey, let's look at these. And I agreed. And sometimes what you can do is look quickly at an organization and see what the company is worth. So in the case of when I made the trade in Carnival Cruise, this is what I did. So I looked at Carnival Cruise, and at the moment it was trading at about $5 billion market cap. And so what I did was I looked at the assets and liabilities on the balance sheet, and it looked like it was like trading at a book value of like 0.5. And what that means is, I forget exactly what the asset number was, and I forget exactly what the liabilities number was, but I think it was like $10 billion. And so what that means is, if the company were to get liquidated, they would be able to pay off all the debt and still have $10 billion of cash left over. But at the same time, the cost of the shares was worth half of that. So the company on the open market was trading about $5 billion, but if everything were to be liquidated, it was trading basically at a $10 billion valuation. And the same was happening with Royal Caribbean. It was around the same. And so when I was like, okay, well, just based off of that, the stock is worth $15 to $16, right? Just if like they were to say, hey, we're going belly up, we're selling everything, somebody will gladly take all the parts and sell it up and get their money back, or buy the whole thing and say, for a 50% discount, essentially. So you can look at a company that way and say, well, how does this relate to the book price? Is it trading at a discount to book price? Is it trading at a premium? So, for example, UPS is trading at a substantial increase to book price. So it's like many multiples. So if you were to take the debt and basically look at what assets there are, I think it was like $3 billion or something like that. But the company itself is trading for like 80 billion. So it's like, take 80 billion divided by 3 billion. I mean, if the company were to be liquidated, you're not going to get much money, right? And that's basically what it's saying. Banks and stuff like that, if you were to do the same, you could say, well, the banks have $200 billion of shareholder equity, just taking assets minus liabilities, and it's trading at X sort of X sort of multiple compared to the book value. So that's the way you can kind of look at things. Another way that I like to look at things goes back to the cash flow statement, which I talk about a lot, and I apologize if I'm kind of beating a dead horse. But if you look at what the free cash flow is, or just what the ops cash is as a whole, so it kind of goes back to revenue, then you have the cost of the goods sold, and then you have like your general basically operating expenses to pay workers, to pay yourself, to pay everything. And then you have the remainder that the business can use as retained earnings to either put back into the business or distribute as cash flow or distribute as purchasing stock buybacks and stuff like that.
And where do you get those sheets?
What's that?
Where do you get those cash flow sheets?
Yahoo Finance is phenomenal for that. So if you just go to Yahoo Finance and look specifically, Charles Schwab, I'm sure, has those as well.
Yeah, I'm trying to flip around in the interface and I'm not finding them, but they're probably here somewhere.
Yeah. So I know Fidelity's really well. So if you were on Fidelity, I'd love to have a one-on-one, without all these people here. I don't want to bore them and show you where you can find it. But I'm sure Charles Schwab is similar, where you kind of just look up the stock and then it'll tell you everything basically like Yahoo would. But it also would have like financial statements and stuff like that you can pull up. And that'll pull up the income, cash flow, and balance sheets for yourself. And so what I would do is I would just look and see, one, does the company make enough cash and free cash to pay the interest and stuff like that? And that's one of the other things that I looked at for Carnival Cruise is, do they have enough cash on hand that if something like this were to happen again, where they have, let's say, $2 billion on hand and they weren't going to be able to operate and pull in any more revenues, do they have the ability to pay off the interest, not the debt, but the interest for the time being with the cash on hand in the case of, say, ceasing operations? Granted, there are a bunch of other things that you would do with that cash, because obviously no revenues, you still have operating expenses that you still sometimes have to pay. But that cash can be utilized as a buffer for any sort of things like that. They can use for working capital and what have you. Um, but yeah, I would look heavily into that, understand what kind of multiple these things are trading at. So when I mean multiple, I mean what kind of cash flow numbers are they creating? So earnings before interest, taxes, all that. And what if they're trading at, let's say, like a 10 times earnings before taxes, depreciation, and everything like that to enterprise value, meaning what it's trading for on the market, it looks like it's a good business, right? And so another example is to take cash on hand into account, right? Because companies like Google, Berkshire Hathaway is a good example as well. Some of those companies trade at like a multiple of like, let's just say 12 to 15 times, let's say, earnings, but they also have hundreds of billions of dollars of cash on hand. And so Google, for instance, might be trading at like a 22 times earnings, let's say, but they also have like $100 billion on hand. So the market cap, I forget what it is, but let's just say it's 600 billion. They have, not only do they have the debt and the assets of the company, but they also have like strictly $100 billion. So it's like you can almost take that $100 billion and take that immediately off the share price because this is cash just sitting there. And so instead of being a $600 billion company that you're trying to evaluate, right, it's really a $500 billion company that has $100 billion right there. So for that $500 billion that you're kind of just like paying for the organization, the cash flow generation, and is it a good business to put your money into? Does it make sense, right? Is it making, let's say, $25 billion a year in earnings for it to warrant, let's say, like a 20x sort of earnings multiple? And if the answer is yes, then you put your money in. If the answer is no, it only makes $2 billion and it's worth $500 billion. Is there a way that that company is going to expand its earnings capability? Take an example like a Tesla, where it's continuing to grow, and their earnings are going to continue to expand over time, and it's going to grow into that earnings multiple. Or the opposite, right? Where you have like a GM or Ford, for example, where they're trading at a 5 to 6 times earnings, where you might be like, well, that seems really cheap, right? 5 to 6 times earnings, that means that basically every single year the company is generating enough cash to essentially pay for itself in 5 to 6 years, right? So if you're buying for $10 a share, it's going to be earning, $2 every single year. In 5 years, the retained earnings of the organization is going to be so much. If they're just getting like a simple return on their investment, I mean, it makes sense that the company's share price would obviously expand from that. Because obviously when you invest back into the company, you hopefully have a return on that reinvestment. So the thought is are, let's say, General Motors and Ford going to expand over the next 2 to 3 years? And so I think the point where they have been over the past year and a half to 2 years is a lot of people were worried about an upcoming recession, kind of like what we're in now. And so people weren't willing to pay for 10 to 15 times earnings, those sorts of companies, at the moment, because they knew that earnings would contract in the short term. And so they're going to trade at 5 to 6 times multiple, knowing that 5 to 6 multiple in a year, whenever there's some sort of recession, can immediately jump down to, let's say, a 10x multiple. So hopefully that helps. And I know I'm kind of just jumping around to different things, but
it's kind of proving that I just don't know a lot. I don't know what I don't know.
So yeah, so I'm not, what am I trying to say? What I'm trying to say is,
I've been looking at price change year to date, performance versus S&P 500 year to date, and dividend payout percentages.
Right.
So everything that you've been going on is just kind of like, ooh, I got to look at that. Oh, I got to go look at. Oh, I don't know what that is. I got to research that. So
yeah. So I know I've been shouting like a bunch of different terms, right? But if you can break down a stock, let's just say in 2 ways, right? So the only way a stock price will change is one of 2 things. the amount that people are willing to pay for $1 of earnings either expands or contracts. So somebody's either willing to pay $1 for $1 of earnings or $20 for $1 of earnings. And anywhere in between there, that's the contraction or expansion of a price multiple. So if a company makes $100 and it makes $100 next year, but the price goes up, that means that the earnings multiple has expanded, right? So somebody was willing to pay $10 last year for $1 of earnings. Now they're willing to pay 15 for the same earnings. That either means that there's confidence in the market, or they're expecting that company to grow earnings in the future, or not. And the same can happen in the opposite, right? A price of the company can go down, but they made $1 last year, they're going to make $1 this year, but it went down, let's say 10%. That means that the willingness of people to the confidence in the organization is either decreasing, confidence in the macroeconomic trends are decreasing, the economy are decreasing. And so people are, let's just say, willing to pay 10% less on a contraction basis because they think maybe there's an upcoming recession. So think GM or Ford, right? People are willing to pay less for those earnings because they think there's an upcoming recession, and they'll be held vulnerable for that. So that's the contraction or expansion of multiples, right? And so some companies trade at 10 times multiples. Some companies trade, like Amazon, for instance, at 80 times multiples. And not to say that that's a good or bad thing. It's just dependent on what you think the growth of the earnings and stuff can go forward with in the future.
But that's the other thing is if they were doing 80 times per dollar, then why would you want to? Because I know a lot of people invest in Amazon, and a lot of people have made a lot of money in Amazon because it's just its raw value has gone up.
Right.
But if you're looking for the passive income and you're not looking to, like, I view the Roth IRA as a big black hole, and I've determined that this money is just every week going to be siphoned off into this black hole, and it's someday 20, 30 years in the future, it might get opened up. But for the most part, anything that I put into it is gone for today. So if you're looking at getting $1 back for $80 buying Amazon, why would you want to buy multiple shares of Amazon versus a lot more shares of the $10 per dollar out thing as well?
No, I mean that's an extremely valid question, and I think that is part of the reason why there's so much confusion in the markets, because some people might say that very quickly Amazon could potentially become a 20 earnings multiple company if the price doesn't change, right? So if the price stays at 2,400 like it is at the moment, maybe it's 2,200 at the moment, in a couple of years' time, that earnings can shrink very rapidly. So let's just say people are like, we're never paying $1 over 2,200, and everyone in the world agrees. But Amazon keeps doing what they're doing. They're growing at a very expansive rate, whether it's their cloud business, whether it's their online orders business. And so very quickly in 2 to 3 years, that earnings, which kind of gets into the second part, which I'll come back to, their earnings grows, right? So fingers crossed. I mean, e-commerce is only going to get bigger, and Amazon has a huge market share of that, and it's continuing to grow. And so that 80 earnings multiple might be an 80 earnings multiple for now. But if you start to look back what it was priced at last year, let's just say their earnings grew 10 to 20% from last year. You might have been paying an 80 earnings multiple for last year in 2019 when they were only like $1,600 a share. They've actually grown so much that they've grown into an 80x multiple even into 2020. And that's just because they've grown their earnings per share by 10 to 20% or what have you. So it's not necessarily there's the earnings multiple of things, and then exactly what you mentioned, there's the expansion and contraction of the earnings multiple. Then there's just the changing of earnings as a whole as well. So that's the two ways that a price of a stock can change. There's the contraction and expansion of earnings, but also companies can grow their earnings per share as well, whether that's financially engineered, manipulated, like say buying back stock, or whether that's actually increasing the return on capital invested in the organizations. They take $10 to $12 billion and invest that at, say, 20%, they're automatically going to grow their earnings next year by, let's say, 10 or $1 to $1.2 billion, depending on what their return is. That's all things that they can then do. And same thing with Amazon. If they retain some of that earnings that they have, granted, it might be small. They might have only made like $1 billion, let's say, in 1Q of 2020, and it's a $800 billion company or $1 trillion company, actually. They could take that $1 billion, reinvest it back in, and their margins on that $1 billion that they invest are so huge, whether that is, let's say, 80%, 90%, but they can invest that $1 billion and immediately increase the value of the organization by, let's just say, $800 to $900 million just based off of reinvesting that $1 billion. I mean, that's a good business. So it could eventually get to the point where Amazon makes so much money that they do become some of these other organizations where they start to slow down in growth and eventually start paying a dividend. Like Apple, for instance. Apple, while their earnings have kind of slowed down slightly, granted, they still make like a huge sum of money every single year, if not the most profitable organization, arguably, over the past 10, 12 years. They've started to recently increase share buybacks and pay a dividend because they recognize that they had so much cash on hand that it was better in the hands of shareholders rather than continuing to, let's just say, reinvest it back into the business. So I understand what you're saying. It's tough to designate whether or not you invest in a company that's trading at 80 times earnings versus 10 to 20 times earnings. But I think it is in the eyes of the investor. Are you investing in the future organization, which can continue to grow, let's say 4 times or 5 times into that multiple, where in 5 to 10 years, they predict that instead of they're making their $1, they're making $4. So you might be investing in Amazon today saying, well, in 3 years, they think they're going to make $4 a share. I'll pay 80 times 2020 earnings for 20 times 2024 earnings and continue to grow. Let's just say they predict in 10 years they're going to be making $10 a share. Then it looks cheap, right? I mean, if they go from $1 to $10 a share in the next 10 years, then technically you're investing in an organization. Then in 10 years' time, you're buying it at an 8 times earnings, and they might not be predicted to be done. I mean, if they continue to grow earnings. So that's one way you can kind of look at it.
So basically, if you're buying a stock at $100 a share, and then in 5 years it's now $500 a share, and you're getting dividends based on the current one, so say it's 2% or whatnot, then you're getting 2% of 500, even though you bought in at 100. So you're now really getting more like 20% dividend based on what you invested at.
Not necessarily. So the percentage yield is back calculated. So the company pays out so the yield of a company goes up and down every single day. So the company board of directors say, based off of our cash flow, we think we can reasonably pay out to the shareholders $1 billion a year. And the company is, let's just say, worth $100 billion that year, or at that moment, based off the share price. Because the share price is just determined by supply and demand in the market. People either want to buy the stock or they want to sell the stock. If more people want to buy the stock than sell it, the price goes up. More people want to sell it rather than buy it, price goes down. Unfortunately, it's as simple as that. And that kind of goes back to the earnings multiple question. People want to buy it considering what the earnings capability of the company is now. And more and more people want to buy it. That either means the earnings multiple is going to expand on the organization, or if more people actually want to sell it, the earnings multiple is going to contract. But the company and the board of directors determine $1 billion in payout this year. That's what we can afford. We made $10 billion this year. We're going to need $8 billion to reinvest back into the business because we have this grand scheme or project that we want to do. That leaves us $2 billion left over. We want to give half that back to shareholders. And based off of the $10 billion we made, the market at the moment evaluates that company at $1 billion or $100 billion, let's say, sorry. So let's just say it's $100 a share. The company is going to pay $1 billion in cash flow to investors as dividends. That would mean you would be getting, crap, I lost myself. $1 billion, $100 billion.
I think I get where you're going with it.
They're going to be paying you 1%. So that once the stock goes up, let's just say it goes up 5%. The board of directors still said we're only going to pay $1 billion. Now the dividend yield went from 1% down to 0.95%, sorry, because you're still only paying $1 billion of dividends to a $105 billion organization, right? And the same would happen, let's just say, if the organization went up now to $200 a share or a $200 billion organization. The board of directors still is saying at the moment, maybe they want to increase the dividend yield. Maybe they want to keep it at $1 billion. But if they want to keep it at $1 billion, let's just say the earnings didn't grow, but the confidence in the organization has, and people wanted to now pay $200 versus $100, or they think the company's worth $200 billion versus $100 billion in this case. Now you're only going to get a 0.5% yield because the company's still paying that $1 billion in dividends. Now, it could very well be that they could increase the dividend, say, 500 times over the course of 5 years, but it's probably not likely unless the company's pretty brand new and they just started implementing dividends or something like that.
So like ExxonMobil, I'm looking at ExxonMobil right now, and at least in the Schwab tool here, it says dividend yield of 8.07%. So why would you want to not invest in that and invest in something like Home Depot that's looking at a 2.75?
That's a perfect question. It is all dependent on, do you think that the company can sustain that 8% dividend for the long term?
So you're kind of like,
really off the bat, you would say, well, I'm going to get 8% of my money back of what I invested every single year. So I invested $1,000. I'm going to get $80 every single year. But keep in mind, at the moment, oil prices are now very low. So that's when you would kind of look in to, say, the cash flow statement, and you could say, well, based off of what Exxon pays in dividends, which is at 8%, you could then go back to looking at what the price of Exxon is at the moment. And I think it's just under $200 billion. So I use $200 billion as a market cap. Maybe it's 100.
So you're talking the total value of the company. It says market cap is 182.5 B.
Okay, so 182 billion. Let's just say 200 billion for easy math. It pays 8%. So that means every single year they're paying out $16 billion in dividends, or a little bit less, obviously, because we round it up, right? So they're paying 15 billion. We'll just say 15 billion. They're paying $15 billion in dividends. Can the company sustain that for the long term? So then you would go to the cash flow statement. You would see the net income of the organization was, let's say, 35 billion last year. They have depreciation, amortization, and they also had to fund for capital expenditures in the business as well. So let's just say, for instance, they had $40 billion last year in cash flow from operations. They had to spend 25 billion in capital expenditures to put back into the business. That means they have $15 billion left over. So they have $15 billion in dividends they owe to shareholders. They pay that out. Now they have nothing left over to put or keep back into the business. They already invested 25 billion that year. So now that earnings, or at least the revenue, is now going to shrink for Exxon because oil price has gone from $50 to $60 a barrel down to below $20 a barrel. Just quick math, not saying 100%, but that $40 billion that they used to have in cash flow from operations, it's let's just say now going to be closer to $15 billion in operations. So one of two things has to happen. So they either need to cut their dividend, because now they only have $15 billion in cash flow because their revenue got cut in a third. And let's just say everything's like for like, and their operating margins don't change or anything like that. They're either going to have to cut capital expenditures, which were $25 billion last year, or they're going to have to cut the dividend to make sure that they don't have to issue more debt, or they issue more debt so that way they can inject it into the company and say, say, we'll fund the dividend by paying debt or getting debt. Or you
Probably
can look
not
at
the best
something.
move.
What's that?
Probably not the best move.
Yeah, exactly. So it's kind of like personal living, right? It's like, well, you can continue to invest let's just say $15, right? We'll take your personal example, or maybe closer to like a home independent example. You get let's just say $400 a month in a paycheck. You have, let's just say, $250 that goes to your mortgage and groceries and stuff like that. And every single month, you made a determination that you're going to put $15 or $150 into your investment accounts. All of a sudden, you either get furloughed or the company decides we're going to cut 30% of everyone's paycheck. So instead of $400 a month now, you're making $280 a month now, unfortunately. So that either means you have to get rid of your mortgage, you have to stop getting groceries for the family, because the three things that you were doing were, one, making $400, now that's $280, and your normal mortgage payment and groceries was $250 a month, and you were investing the remaining $150 a month. So one of three things has to change. You either have to get your income back up, you either need to change how much you're spending on mortgage, groceries, or what have you, or you need to stop investing what you're investing, that $150, trim that down to $30, or you could put your $150 remainder, or the $30 plus the $120 that you have now as a deficit, onto a credit card. So that's basically the thought process. Now, when you're evaluating different companies, going back to your example of home or ExxonMobil versus Home Depot, it all depends on what you think will continue to sustain the dividend or grow the dividend over the long term. So AT&T is a perfect example of this. You can invest in AT&T.
They are right below it on that sheet.
Yeah, I swear I'm not hacking and I'm not looking at your sheet.
6.96% dividend yield, and they're at $214 billion.
Perfect. So I know for a fact that AT&T pays, I'm going to go out on a limb, pays $2.08 every year, per share in dividends. So they also only grow it at about 2% a year. So they keep up with inflation. So you can invest in, say, AT&T at, say, 7%, or invest in Home Depot, which might be growing their dividend closer to 20% a year. So if you would say, do an investment in AT&T, it's going to grow 2% every single year in terms of the dividend. So it'll take 36 years for that to go from a 7% yield based off of what you invested to a 14% yield. Or you can invest in something like AT&T, where it will be, not AT&T, Home Depot, where it's 3.5%, let's say, and they're growing it at 20% a year.
That's pretty close, 2.75. So yeah.
What's that?
It's 2.75. That was pretty close.
Okay, so 3%. Okay, we'll just say 3% to make math easier.
Round it out.
Let's just say they're growing it by 25% a year. So 25% dividend increase every single year. That means in 3 years, just about, they'll be at a 6% dividend yield based off your investment. And then 3 years after that, they'll be at a 12%. So it'll take you 36 years to go from 7% to 14% on your investment in terms of dividends coming from AT&T based off that 2% growth. Whereas if Home Depot can do the same, start at 3%, but grow it at 25%, and this is optimistic, but grow it at 25% per year, it'll take you 6 years to get to 12% dividend yield off of your investment. So you can kind of look at it that way and say, well, in terms of growth in the future, would I rather invest in Home Depot, which is growing at, say, 20% a year in terms of their dividend growth, or would I get a fatter dividend yield now at, say, 6-7% for AT&T and just grow it with inflation, right? So it's very dependent on what your expectations are. And going back to earnings reports, and do you think that it's worthwhile to invest in a certain organization, and how fit are they for the future? Do they have, let's just say, are they pulling in $40 billion a year, but they have to pay out $38 billion of that in interest and taxes, and that leaves them $2 billion left over to give to you as a shareholder? Or are they something like a Visa or a Google, where they just have so much cash flow and they don't have very many expenses? They're very lean in terms of what kind of debt they take on, and they pay for everything or a lot of it in cash. So they don't have that extra stuff that they have to pay for interest on debt and having huge capital expenditures, because it's all digital. It's not physical facilities that they have to invest in or anything like that. So
Okay. I'm going to get going here
everything.
because you probably got other people that are looking at for questions. I do have one other quick question though.
Yeah.
And you've
Everyone
already
left
blown my
because
mind
I've
with
just
tons
been
of
going
stuff.
off.
Oh, really? Sorry.
Yeah, that's all good. Well, no, I
Um,
mean, people are on the stream, I assume, but there were people in the lobby, but they
oh, I
left.
didn't see him. Okay. You mentioned something with, I think it was Visa the other day, or somebody that I was actually looking at investing in, and you said you wouldn't want to put that into the Roth for a whole bunch of tax reasons or something like that. I thought Roths were immune to taxes. So
No,
if
so I think I know what you mean. So unfortunately, so I'll tell you exactly what happened. So I'm a high income individual. So I technically can't contribute directly to a Roth IRA anymore. And that happened probably like 3-4 years ago. And so what I meant by this, and I'll kind of explain it so hopefully it clarifies, was during that time period, I went transitioning from someone that was eligible to invest directly in a Roth IRA to someone that either had to start phasing out or not contribute to a Roth IRA directly at all. I still invest in a Roth IRA, but it's through a Roth conversion. So I invest into a traditional, that I call up my broker or my investment house, and I say, I want to do a Roth conversion. We could talk a little bit more on that offline.
I don't think I'm anywhere near that yet, so I don't think I have anything to worry about that.
They don't. If you ask them, I want to do a backdoor IRA, they won't answer the question. So in the future, if you ever get to this point, say you have to do a Roth conversion, at the moment it's a tax loophole. So unfortunately, during that year, I had Visa at about $75 a share, and I had, I don't know what it was. It was a smaller investment because back then I didn't have as much as I do now invested. But unfortunately, I had to sell something because I contributed too much to my Roth that year, and I was in a transition year. And so I had to take something out because I couldn't contribute the normal. It was either 5,000 or 6,000 that year, unfortunately. Maybe it was 5,500. And so unfortunately, I sold Visa. And by the time I actually did all the workaround, did the Roth conversion, got that money back into a Roth IRA for the next year, Visa had gone up to $110 a share or something like that. So unfortunately, I had to do that whole runaround. What somebody else might have said about Visa. So if it wasn't that specific story, and I don't know if it was, but if it was,
I'm guessing it was because I'm pretty sure it was you, and you said that's something I'm going to address later.
Yeah, so I probably hopped over it relatively quickly. So that
and then I'm like, oh, I can't put Visa into a Roth. Okay, I won't buy that stock.
But one of the reasons why you might not want to put Visa into a Roth is dependent on your dividends. So Visa, while it's a huge, great company that I think is very investable, and if you don't have shares at the moment, I would recommend probably buying some, although it's kind of expensive at the moment, in all honesty. I would prefer getting it down to the 150 or below for sure. But it is a premium stock. So generally speaking, it trades at a premium in terms of earnings multiple. It trades at a relatively low yield. So take, for instance, AT&T. If you were to put $1,000 into AT&T, you'd get $70 a year in dividends. If you were to put $1,000 into Visa, you'd be getting what is that, $8 or so in dividends. At the end of the year, you'd be taxed. Let's say you're 15% in your tax bracket, let's say. And so you would have to go to the tax man and say, 15% of $70 is what? And then you'd have to pay, let's just say that's $10, right? So you'd have to pay $10 if you had AT&T in an individual brokerage account. For Visa, you would have to pay, what is that? I'm not that good with quick math, so what is that? 12 cents. You'd have to pay 12 cents. Sorry, $1.20. I'm sorry, for Visa taxes, right? As opposed to the $12 or $15 you'd have to pay for your AT&T taxes. So if you were to invest that $1,000 and put it in a Roth to avoid paying that $1.20 for Visa or $10 to $12 for, let's say, AT&T, you'd preferably put AT&T into the Roth. So that way you're saving essentially that $10 to $12 versus that $1.20. Does that kind of help?
Yeah.
Okay.
Yes.
So another thing for Roths, while we're at them, is there's key things called ordinary dividends or qualified versus non-qualified dividends. Now, depending on your tax bracket, these might be important or they might not be. But qualified dividends are companies like AT&T, Visa. So if you're investing in those, it's as simple as looking at what your tax bracket is and understanding if you're going to pay 15 to 20% and what their dividend yield is, and just being like, okay, well, at the moment, Visa is paying 1%, AT&T is paying 7%. Let's put it in the Roth. And I want to get back to that because it's maybe not 100% perfect to state just that. There's another component in a Roth as well. But talking about non-qualified dividends, those are some things like real estate investment trusts, MLPs, master limited partnerships, business development companies. So companies that are tax sheltered organizations, they pass on the taxes to the shareholders. So real estate investment trusts, they have to distribute 90% basically of what they earn to the shareholders, and then the shareholders have to pay the taxes. Now, instead of paying the 15 or 20% dividend tax that you would have to pay for AT&T or Visa or normal qualified organizations, you actually end up having to pay your normal tax bracket. So if you're in the highest tax bracket, you'll have to pay the 37% tax on that. So instead of being taxed at say 15 to 20%, now you have to pay 17% extra just because of the type of organization you're investing in. So those sorts of companies would be best to be put in a Roth IRA over, let's just say, an AT&T or Visa. Does that make sense?
Kind of a little bit. I'm going to have to rewatch this video.
What's that? Oh, no.
I'm going to have to go back and rewatch this.
Like I said, I have time for anybody. So if you ever just want to book one-on-one time, feel free to reach out. I'm more than happy to do that. But going back to another part of the Roth IRA. So we touched on the dividend aspect of things, but one of the things that we didn't talk about was capital gains. So Visa is in an emerging industry as well, where cash is still the main transaction form that people have throughout the world. And so if you believe that Visa is going to continue to grow at the large rate that they have been over the past couple of years, and AT&T is going to maybe continue to grow at that 2% range, what might end up happening is, in terms of capital gains, your $1,000 investment in Visa versus your $1,000 investment in AT&T over, say, the next 20 years, your investment in AT&T may have gone to $2,000 or $2,500. Your investment in Visa, sorry, I might have screwed that up. Your investment in AT&T might have gone from $1,000 to $2,000 or $2,500. Your investment in Visa, depending on how fast it's continuing to grow, people continue to utilize cards instead of cash, especially in countries where cash is still kind of the main transaction vehicle in the moment. Visa might grow revenue and earnings by, let's just say, several times, and depending on if people still want to pay that premium for it, could grow to a $10,000 stock, or not $10,000 per share, but $10,000 position rather, $15,000. So if you have that in a Roth IRA, what you would have to pay for in, say, the 10, 15 years when you sell it is the normal long-term capital gains tax that you would have to pay. So if you were to have, let's just say, AT&T in your normal taxable account, you'd have to pay the capital gains on, let's just say, went from $1,000 to $2,500. You'd have to pay the capital gains on that $1,500 difference, right, between what you sold it at versus what you paid. In the terms of Visa, you'd have to pay the difference between the 1,000 to, let's just say, 10,000 or 15,000. So you'd have to pay either a $9,000 to $14,000 difference on that, and then have to pay the long-term capital gains. So,
and that's if it's not in the Roth. If it's in the Roth, if it's in the Roth, then you don't have to pay that, correct?
Exactly. So you have to evaluate two things. You have to evaluate: do you want to pay for the dividend taxes now, and keep the long-term capital gains in the Roth, or would you rather do the opposite and say, have the high growth company, like let's say a Tesla, or if you really think it's going to go to 3,000, like some of these people say, or let's just say a Netflix, if you think it's going to double in a year, maybe you want to keep that capital gains in the Roth, because then when you sell it, you don't have to pay any taxes. So there's the two ways that you can kind of look at the Roth. It's the dividend taxes that you have to pay on a quarterly basis or at the end of the year when you have to file your taxes, or it's the long-term capital gains. So that's two ways to kind of look at it. So hopefully that helps out. So I apologize if I jumped around a lot, but hopefully that answered your question.
Yeah, that answered a lot. So
very good.
I'll have to go back and watch this a few times.
Yeah, and if not,
a little bit more
to me or Kyle. We're more than happy to sit with you, and hopefully we're able to answer some of your questions. I hopefully was able to answer some of them. So
yeah, and a one-on-one I could do like a screen share of but this has got like account detail information, like account numbers and stuff on the screen. So I don't want to
for sure. Yeah, you don't
share that out on a public stream.
Yeah, I've accidentally probably done that once or twice on some of my videos, so don't worry.
Cool. All right. Well, it's good talking to you. Thank you much.
Yeah, no, I appreciate it, and always reach out. And of course, if you're not in our WhatsApp group, I should actually do that. Well, if you're not in our Facebook group or WhatsApp group, just let me know. But for anybody that's listening,
I'm not.
What's that?
I'm not.
Okay, so anybody that's listening, if you want to join our WhatsApp group, we got like 30 people in there. We talk about it all the time. We talk about investing. We share current news and what have you. So for you or anybody else that's listening, if you just WhatsApp message, I'll just leave it in the comments here. If you just WhatsApp message me using this number and say, hey, I want to join the group, I'll send you the link and you guys can join. We talk about it all the time. Talk about investing. We talk about just normal life stuff as well. We talk about, business, what's going on. So, just WhatsApp me. And if you just normally message me using normal messenger, I won't answer because it will cost me a crap ton of money to message you back and forth. So appreciate that if you use WhatsApp, because then that's over the internet, not over normal cell tower. So thank you, Pelwork. I appreciate it. And look forward to seeing you on the WhatsApp group, man.
Will do. Thanks.
All right. Cheers, brother. All right. So we have a couple other folks sitting in line here. Let me just double check some questions that we got here. So question, so for everything you're covering, like financial sheets, like understanding financials, this way to value companies, is that covered in the classes that I saw? So yes, Kyle does have a few of these things on Passive Income Educator, which I think is in the description of this video. Kyle did some good videos, and if you're interested in like creating websites and stuff like that, Kyle did some videos on that as well. I'm also going to do things like what we kind of talked about here about Roth IRAs and 401ks a little bit as well. So in the coming weeks, I should have that. And Tony, I recognize that you're sitting in the wings here, so I appreciate your patience. I'm just going to answer one or two of these questions, and then I'll get to you in the long term. So how are you so knowledgeable about stock trading? Any books or courses you recommend? So a lot of this has to do with me just doing it for the past 7 years, learning as I continue to go. And I did read a few books. So keep in mind, when you read some of these books, you have to recognize there's multiple things you have to recognize. What lens is the author of the book coming from? Are they a swing trader? Are they a day trader? Are they a long-term buy and hold investor? And understand what similarities or differences you can take from their strategy to apply to your own. And so a really good book, for example, is, I don't know if it's called Fast Money or if it's called Get Rich Carefully with Jim Cramer or what, but I read a great book by James Cramer. I think it was his second book, not his first. And it talked a lot about swing trading and the economic cycles. And I think I've mentioned this in a couple of videos as well. But um, what it did was it made me understand that in late life cycles, kind of like what we're in now, and we're starting to enter a recession, consumer goods companies that, are your, long-term, non-cyclical sort of businesses like your Cloroxes, your canned food companies, things that like don't go out of style, are the places that people go to during times of uncertainty and recession for safe havens, because people are always going to need those things. People are always going to need trash bags. People are always going to need Tupperware containers and stuff like that to continue their day-to-day lives. And so people might say go against and buying things like auto companies. They don't necessarily need a car when people are getting furloughed and unfortunately laid off during these times of volatility. And so hopefully that can give you an understanding. It's like, well, maybe if you're a buy and hold investor, I can understand where you're coming from. Those companies may or may not fit into your portfolio. But something that's important to know is, well, if we're entering towards the late life in an economic cycle, like we have been for, say, GM, Ford, and the rest of the organizations that we're kind of seeing as we enter this recent bear market, it might be wise to say, well, we're entering the late life of the economic cycle. In the next quarter or two, or maybe next year or two, GM or Ford or some of these technology companies or what have you could get cheaper. Their earnings multiple could contract because people would be less willing to pay for those, or they might be selling out of those organizations and moving them into the safe havens like your industrial companies or your Cloroxes or your Waste Managements of the world. So hopefully that kind of helps. And you kind of see that going on now with the current downturn in the market. You're not seeing your great quality companies that have very strong sort of market shares hitting the rocks like some of these other companies. So really appreciate that question. And this one's from Tone. I appreciate this one a lot. I agree with you 100%, and appreciate the kind words about liking the channel and my voice. It means a lot. I don't really necessarily like my voice, but it seems like other folks find it soothing, I guess, and don't mind listening to it for 2 hours or so. But I agree with you. Professional mic is one of the things that is on the top of my list. Currently, I'm in Trinidad and Tobago recording a lot of these videos, and I have been since August timeframe. So unfortunately, the top of my list is getting potentially a new computer, a new laptop to help make videos better, as well as a nice camera, as well as audio equipment, so I can make better quality videos for you guys. That's on the top of my list at the moment. But unfortunately, international flights out of Trinidad at the moment are canceled until at least June or July. So, and we're just getting ramped up and starting our economy back, just like the United States here in Trinidad and Tobago. And so when I go home next, I plan on buying some good computer equipment. So I appreciate that comment, and hopefully you guys can wait and be patient with me over the next couple of weeks, as hopefully we get that. Any advice you can give on sectors hit hard like energy, financials, and real estate, where you're down 40 to 50% average hold? In March, you were buying other sectors but ran out of dry powder. So I think that this kind of goes back to what your investment strategy is. And just a quick moment, Tony, I think this is the last question I'm going to answer, and then I'll hop on with you. So appreciate your patience, my brother. So with respect to this, I think it's very key to look at the companies that you're invested in. Do you think you want to hold those companies for the long term? Do you want to double down? Just because you're down 40 to 50% in a stock doesn't necessarily mean you should add more capital. If you believe in the stock and you think it's going to come back, you like the balance sheet, you like their earnings potential in the future, you think they have the wherewithal to come back after this sort of volatility that we're seeing in the market full term, then it's something that you might want to average down in. But if it's something like Carnival Cruise, let's say, and some of you guys might have polarized views on this, you might think, well, looking at the balance sheet and looking at what I think in the future for Carnival Cruise Line, it doesn't look good, right? I mean, it doesn't look like it's going to be, coming back in the future. You might want to cut your losses, unfortunately. Or you're in the camp of, I looked at the balance sheet and I think that, their interest payments are only $110 million a year and they have $2 billion on cash and they extended some more credit facilities. And I think over the next 6 months to a year, they're going to get back to a decent amount of revenue. And I think they're going to come out of this okay. Then it's maybe something you want to invest down in. So I don't think that there's a net clear way to kind of say, hey, I'm down 40, 50%. Should I double down? I think it's a case by case basis. If you're in an energy stock, I wouldn't go chasing after, let's say, an Occidental and say, I'm down 80%. Since I'm down 80%, I'm going to triple the amount of money that I have in it to try to lower my cost basis. If my, say, Royal Dutch Shell or my Exxon is, say, down, let's just say 50%, and I'd rather invest in those companies, right? And in fact, maybe I'd rather sell my Occidental if I think it's not going to meet its cash flow obligations. I mean, it's already paying Warren Buffett, let's say, in stock rather than paying him in cash for his preferred shares. And I don't think that in the near term, with oil prices the way they are, they're going to be able to meet their normal debt obligations, which they have a lot of. You might want to cut those losses and invest them in things that you think will be good for the long term. So it's all about capital management and understanding what your risk tolerance is. And if you think that this is more risk, let's say, than a company like, let's say in financials, like if you're saying, well, this company is down 50%, let's just take Occidental, for example, is down 50% from where you invested in it at, and JP Morgan is down 50%, and you think JP Morgan is going to come out of this perfectly strong, well, it's worth taking that 50% loss, and let's say on a like-for-like basis out of Occidental and putting it in JP Morgan, because you think JP Morgan is going to go back, let's just say, back up to 100% of what it was, or you think it's going to continue to make all-time highs. And so I know that's generalizations and, comparing things on a like-for-like basis, but it's a very case-by-case basis in a lot of these sorts of questions. Just because a company is trading at a 40 to 50% discount compared to where it was doesn't necessarily mean that it's in 40, 50% less earnings capability than it was just 2 to 3 months ago. So keep that in mind for the future. So appreciate that. I'm going to bring on Tony here because Tony was sitting in the lines for a little bit. Tony, how are you doing, sir? Can you hear me okay?
I'm doing great. I can hear you. I don't know why you can hear me.
Yeah, I can hear you great, brother. How are you doing?
Good. How about yourself?
Very good. I appreciate you coming on.
I appreciate you having me. I didn't know you even did this, to be honest, till now.
Oh, well, to be 100% fair and transparent, I used to do this once or twice a month, probably about 3-4 months ago, and then I've just been slacking. So it's nothing on me. But Kyle and I set up some stuff. So if people want to have one-on-one chats with us when there's not, say, I don't know how many people are watching at this point, but 40, 50 people, let's say, in the future, and you just want to have a conversation one-on-one with us, just reach out to us, and we're happy to do that. But how can I help you, man? I'd love to talk to you and figure out what you're thinking.
Well, a couple things. Hopefully it's not bad that I called in because I'm not a new investor, but I wanted to talk to you about a couple of things because you seem like you're very knowledgeable, and I like that. You're actually taking time to do something like this. But I wanted to talk about what you just mentioned, which I hear a lot. It's kind of like a universal, where like all investors say a certain thing. Now, I think that I personally invest a little bit differently than most investors, but I wanted to talk versus Visa.
Sorry, you're cutting in and out a little bit. You wanted to talk about who versus Visa?
AT&T versus Visa.
Okay.
Because a lot of people say exactly what you said. I read an article probably about a year ago, maybe 2, and they said that basically, I think it was Visa. It was either Visa or MasterCard. I believe AT&T. Basically, they were saying that AT&T will raise its dividend by 2% a year versus MasterCard had a higher percent. I don't think it was 25%. I think it was quite a bit lower, but a lot higher than 2% by far. and they said after about 20 years of reinvestment through like a drip program, they would be matched. But then after that, Visa would pull away, which I hear that a lot. But what I wanted to ask you about, just another way to think about it, what are the chances when you think about risk reward with investments that Visa is going to be able to pay that high of a percentage for that long of a period of time without lowering it? To me, that's more unlikely than AT&T never paying more than 2% ever. Especially when you factor in like what's happening now. Visa is going to give a huge raise this year with everything going on with the virus. I would think not. So I don't know if you ever think about that, where maybe it's more important to cash flow. Because I think from a cash flow statement, AT&T for a long time could raise it 2% and never be a problem. Versus you look at Visa, yeah, the cash flow's there right now, but when you have those double-digit growths, how long can they really keep up that double-digit growth? I'm sure it'll take a long time before Visa ever gets 2%. But if you kind of compare apples to apples, AT&T I think is more likely maybe 1 year to get 3 or 4% than keep 2% every year. And then if you factor in like a drip program, I think AT&T over 30 years would probably still beat Visa, if you think about it from that standpoint. So I think eventually Visa will end up cutting. They'll get bigger. They won't be able to keep up with those high growth. They'll have to cut it down.
No, I think that's a phenomenal point. It goes back all to what people think the future earnings potential of both organizations are. So I agree with you 100%. Comparing Visa to AT&T is a little bit different than comparing Home Depot to AT&T, because Home Depot is about half of the yield of, let's say, AT&T. Visa is less than a tenth. Crap, It's a little bit more than a tenth of the yield of AT&T. So I think AT&T pays 6.9 or 7% for simplicity's sake. Visa at the moment pays like 0.7 or 0.8%. So it pays about a tenth, let's just say, for easiness, of what AT&T pays. So if you compare that drastic of a magnitude of difference, I agree with you 100%. It's going to take a long time. But another thing you have to keep in mind is a lot of these different things are fluid, right? And I'm not disagreeing with you or agreeing with you. I think that just for educational purposes, what I'm trying to say is there's so many different ways that you can evaluate it. There's how much cash flow is AT&T paying out at the moment as dividends compared to Visa. And I would anticipate that Visa is paying out way less in terms of cash flow of their dividend than let's say AT&T. And so if you were to even just match that, and if we wanted to, we could take a quick look and dive deeper. But if you were to say, I think AT&T was paying like less than 20% of their earnings, or their just as in terms of a payout ratio, then if you were to match that to say AT&T, which probably is closer to 60%, maybe even closer to 70%, I don't know. But if you were to match that, immediately you would go from a 0.8% for Visa to closer to a 3%, so 2.5, let's just say. So now you're getting more into the conversation of, okay, now they're matched out like for like in terms of what the payout ratio is. Now what do I think it is, right? If now let's just say they're paying on an even keel basis in terms of payout ratio compared to their earnings capability, and let's just say, taking out interest and capital expenditures and stuff aside, we're just looking specifically at earnings basis to earnings basis. And actually, I want to kind of look at this as well. So we'll talk about it and then we'll look at it and see if it kind of makes sense.
I think it's 60%. You have to, I know Yahoo Finance is way off. I think they say it's like 104% or something. AT&T, I did the math. And Seeking Alpha was correct. I think it's at like 59%, 57% for the payout ratio. I'm not sure what Visa is. But the reason I brought it up is everybody focuses on the growth. And I kind of think that's more of a speculative play in a sense. And that's the only reason I brought it up is new investors are always like, well, this has growth. This has growth. I'm thinking, like, me personally, I'm thinking, is this company really going to keep that growth up? I think it's foolish for a lot of people to believe that not in Visa. If you believe in a company, that's one thing, but any stock, they just look at the growth and be like, well, look at the growth on this stock. Well, it might have a high growth right now, but how long is it going to be able to keep that growth?
Yeah. No, I mean it's a hugely valid point, and I'm like I said, you're not right or wrong. I think it's all just dependent on when you need the dividends. Do you need them today, or do you need them in 20 years? And so, with let's say AT&T, you have to keep in mind they're paying out. You know, it's also very dependent on what you're investing for. Are you investing for capital gains, or are you investing for dividends? If you're investing for dividends, then obviously the choice would be AT&T. It's called the
Yeah.
widow stock for a reason, right? I mean, people forever have been investing in the Bell organization and now AT&T for good reason, because they pay out dividends. I mean, that's their goal. Whereas Visa, it's newer to the block. I mean, granted, it's been around since forever. It's older than me for sure. I think it's been around since the 40s or 50s. But in terms of where they are in their life cycle compared to AT&T, it's much smaller. So I agree with you. It's very dependent on who's investing in it. If you're an older individual and you need the money now, AT&T is your stock, right? But if you're 20, 30 years old and you're looking out for, say, the next 20, 30 years, it could be Visa or it could be AT&T, depending on, if you're investing for, say, what I'm doing for investing, or what our gentleman that we just had on was investing for, in the case of, let's say, furloughment or having income stability in times of, so let's just say, volatility in the market like we're experiencing in the oil and gas industry for me at the moment. AT&T could also be very well a choice, even though I'm 28 years old. And so I think that a lot of this goes back to what I mentioned when we were talking about the book that James Cramer wrote. He's a swing trader, right? So I read what he wrote, and he was looking at it through a lens of a swing trader. So somebody that might hold on to a stock for a day, somebody that might, well, maybe not a day, but a week, or up to 6 months to a year. Whereas I look at things as holding them hopefully forever. And so a lot of people need to understand that everyone's going to have a different perspective. A day trader is going to have a different perspective than a swing trader, than a long-term trader like myself, or investor, I'd rather say. And so whenever something comes out of somebody's mouth, they have to understand where that person is coming from and what strategy they're coming from. And so it's a really good point, and I'm glad you brought it up, because when I was doing that quick discussion with the last individual that was on, you're 100% right. I was thinking about it strictly from one perspective. But you're 100% right. If somebody's 65 and they want to retire next year, AT&T could be their stock, because they have $100,000 and they just need to meet an income goal today, and they want to make an extra $500 a month. AT&T is their stock right now, right? I mean, if they think it's a good quality company and they're gonna continue to pay their dividends, and they're gonna be safe over the next, say, 5 to 10 years, or let's just say hopefully 30 years, while this person's in retirement before they unfortunately pass on, AT&T is their stock, and they need that money in next year, not in, say, waiting for Visa to grow 20% for the next 3 years, 10% for the next 5 years after that, and then unfortunately get to the point where they are with AT&T, to the point where they're growing at 2 to 5% for the long term. So I agree with you 100% in that respect.
Yeah, I probably should have mentioned that, because I didn't take that into consideration. Where a growth investor, I think Visa, if you're worried about capital appreciation, Visa is the way to go. And just my opinion, over AT&T. AT&T, of course, could probably go up to $50 if they did everything right. Pay off the debt. I think they issued a lot of shares for the purchase, so I do think some stock buyback should be done to get some of the purchases from buying Warner Brothers back, some of the diluted stock out of the market. But the only thing I wanted to bring up is there is a lot of dividend investors. I think that's the thing. And a lot of people, they look so big on that growth, and they assume that if the growth is, let's say, 12%, that it's going to be 12% for 100 years. And I'm like, and I just think, everybody says that. There's, like, you mentioned it, where you talked about how big the growth is, and how after so many years it's going to pass 18. But I just think that it's important as an investor to kind of think that in 20 years, you might hope that growth will be there, but what's the likelihood of the growth being there if you're a different investor? And I do try to buy every stock as a better stock. So any stock I will sell as well. So, like if AT&T had a big hole in that, quite a bit of shares. But if they crash, and let's say the fundamentals change, the business is doing good, maybe they do get rid of that dividend, then yeah, I'd probably sell. I mean, hopefully I've been buying pretty low, especially now I'm buying a lot. Hopefully I can still get some capital gains in there and move on to a better stock.
No, I would agree. And that's all, like you said, I mean, it's all very dependent on what each individual investor wants to do. But I just did some quick looking. I mean, to give everyone the numbers, and I appreciate this conversation because one, it's a challenge back on something that I mentioned that somebody could necessarily take out of context or in a certain perspective, like you mentioned, and immediately go off and hold it as Bible, which I think sometimes, unfortunately, people do here when they watch these YouTube videos. So it provides a different perspective and shines a different light on the same question, which is phenomenal.
Well, Matt, what I wanted to say though, what you said on that subject is what everybody says. So
yeah,
I haven't heard anyone come to my point of view. That's why I kind of think a little bit different and bring it out. But almost everybody always says, this is the growth. I invest in this company because of the growth. It's 25 years of growth. Well, me personally, I don't believe most companies will be able to keep up with that growth.
No, I mean, I would agree with you, but let's just take example that I was going to lay out for you. So we can kind of have all the cards on the table here. So very quickly, what I did behind the scenes when I was unfortunately looking like I wasn't paying attention, I was looking at specifically the payout ratios. So Visa at the moment sitting at about 18-19%. Let's just round that up to 20% payout ratio in terms of earnings. So I'm not looking at cash flow. So I mean, that could change things as well. AT&T sitting at 58%. Let's just round that up to 60 for simplicity's sake. Visa at the moment is paying about 0.8%. AT&T is paying 7%. So like we said, it's about off by a factor of 10. Immediately, if you were to take Visa's growth rate, and I'm not saying you're wrong by any means, I'm just trying to put all the cards on the table and help people understand. If you were to have a like-for-like payout ratio where Visa goes to the same as AT&T, that 0.8% yield would go to 2.4, right? And just very quickly, if you just say continue the growth rate that, let's just say, AT&T has been able to go to at, let's just say, the 20%, because they keep in mind they are growing like 10 to 20% every year for the past couple of years, right? Let's just say they do that for 3 years, right? Let's just say that for 3 years. Or 4 years, let's say. 20% for 4 years, let's say, instead of forever. They would then take that dividend from 2.4% to, 4.8%, right? Okay. And that might not necessarily still get you to the point where, it's 4.8 versus, say, 7.5% now. For let's just say what AT&T is at for yield on cost, let's say. But then let's just say for now, you're going down to say 5%, or let's just say 7% dividend growth rate for the next 10 years, right? So for the next 10 years, let's just say you're doing 2% still for AT&T. That'll go from 7.5 to say 8.5. Let's just say 9%. That 5% now. I might have lost track in my head, but
you're at 4 years.
I lost track in my head trying to do all the math, but I mean, I 100% agree with you. You can see it and point at it from any different side, and it's all dependent on everybody's situation, right? And if, like I mentioned, if you're 65 years old and you want the dividends now, go with AT&T. If you're 28 years old like me and you're looking for dividends in the long term and you want that capital gains, go with Visa. So it's very dependent, and I think a lot of people utilize that scenario because it's easier to kind of explain than saying, well, Visa's been growing at 20%, but next year it's going to be growing at 15. And then the year after that, it's going to be another 15 again. And then eventually it's going to slow down to 10% or 5% or 2%, just like AT&T. It's trying to hopefully paint a picture to people. And so I understand your perspective that it's kind of like regurgitated information. But it is regurgitated information to try to make an example and try to show people what they should do when they're evaluating a stock, right? Because I think a lot of people, when they first initially start out, and chime in here, because this is a conversation. It's not, we're not at war here, right? We're having a conversation. So I think what a lot of people, when they first initially started investing, and I made the mistake too. So I say this from personal experience. They type in on Google, and I can say this because I've done it, highest dividend yielding stocks, right? And
then they look up monthly stocks too. So I get kind of nervous to see all these people with monthly stocks. There is good ones like Realty or ticker O, but a lot of them aren't that good. There is some, but yeah, I noticed that too. It's all the yield traps. People go chasing the dividend.
100%. I have a stupid question. Are you from Oklahoma?
No, Michigan. Does it popping up Oklahoma?
Okay. So you have an accent very similar to somebody that I worked with in Houston that has a very similar accent to you. So sorry that I'm a little bit off on the latitude or longitude. I'm not exactly sure which one that is. I'm not good with geography, but I'm good at geology, not good at geography. I'll say that.
No, I appreciate everything you're saying, honestly. And it wasn't that I thought you were wrong or anything. I was just hoping to put some insight. And I do like the way you do with the payout ratio, because I do the same thing with the different payout. I compare the payout ratio to the dividend yield. So yes, if one has quite a bit higher payout ratio and one's quite a bit lower, I do the same thing you did with Visa when I'm looking at different stocks. So I do like the way you did. I just wanted to kind of mention it and maybe get your wheels turning, because everybody does say, all the people who know how to invest, they all look at just the growth, and they all picture that same growth out 20, 30, 40 years. And I just basically wanted to maybe get your wheels turning, maybe get some other people's wheels turning, which in a sense, that growth I think is unlikely to sustain long term. Now it could be great. I think 5 and 7% growth is great. So even if in 10 years it's at a 7% growth, that's still fantastic. It'll probably be higher than AT&T. But new investors, they should kind of, when they're looking at the dividend growth, kind of think in 30 years, it's not going to be growing like this, generally speaking. I mean, it could, anything's possible, but generally speaking, it probably won't. But I do think if you're if you're looking for capital appreciation, you're looking to maybe start cashing out, maybe doing a 4% rule, Visa is definitely your way to go there. I think, just me personally, I think it's better than AT&T. But there's a lot of newer dividend growth seems to be very popular right now. That is something I do, but I guess I'm in a different situation too than probably a lot of people as well.
Yeah, and I appreciate your perspective on it and the way that you're kind of bringing in a different lens, because, like I mentioned, I think a lot of people immediately take someone's portfolio off of YouTube and immediately invest it as their own and be like, well, this guy's doing it and he manages. Let's just take, for example, Jeremy from Financial Education, $500,000. He must be right. But then, it doesn't fit their strategy, let's say, and they invest in something volatile like Tesla, let's say. And because he's a big proponent of Tesla, and he wouldn't be upset with me saying that, I anticipate. But they might not necessarily understand the volatility or want the volatility in their portfolio of it going, let's say, down from $850 to $900 all the way down to $350, and they sell when it gets down to $350. And so I appreciate you kind of bringing that light in here, because it does show the different perspectives of somebody and what they should look at from all the different kind of mentalities, and that there's not one solution. There's many solutions, and it's all about what fits into your investment plan. So I truly appreciate that.
Well, I wanted to bring up another light too. I heard you talking. We had that one question. People were talking about, what do you do if you're in financials, energy, or REITs? Remember that statement?
Sorry, say that again.
Do you remember when you talked about when people said, what do you do if you're in energy, financial, or REITs, and you see how down it is? What should I do?
Right. And
you talked about the auto industry a little bit. This is just my opinion, but from what I've been seeing, it seems REITs, supposedly statistically, I haven't done the numbers myself, but they say according to different statistics that REITs outperform even the S&P 500. I think that when there's a market downturn, certain stocks get hit hard. One of it's going to be REITs. Every time there's a recession, REITs are going to get hit hard. The point is, like, people that are worried, I think, if they believe in the company, I think that now's the time to buy REITs, because when everything fixes itself, you'll be getting a heck of a yield if you're looking in the yield, and you also get capital appreciation. You're kind of getting double dipped. If you wait till everything recovers and you start investing in those ones, yield will be okay. Some will be higher, but then there's taxes or ordinary income. So that is a good idea to put them in an IRA. All of my REITs are my Roth. But if you believe in financials, like, I don't think the banks are going anywhere. Unfortunately, the banks kind of control the U.S. It seems like everybody's so indebted to the banks. So the banks own most people. So I think banks are a good investment. I'm not telling anyone to invest in a bank, but if you believe a bank's a good investment, now would probably be the time to get in the bank.
I would agree.
And auto industry, I don't really like the auto industry, to be honest. But if you want to get in the auto industry, I think now's the time too, because every recession they tank back. So if you buy really cheap now and they do go back up and you want to hold them forever, the next recession, you probably won't lose any money. You might be up a little bit because they're going to tank again. But at least if you wait till everything goes up, any kind of recession, any kind of turmoil, the auto always gets hit so hard. So then you're going to take massive losses. So anybody who's thinking about getting an auto, long term, now probably would be the time to buy it. I'm not saying to do that, because auto industry seems a little shady to me, and they don't seem to be the Tesla seems to be on the right track with things they're doing. I don't like volatility stocks, but the business to consumer is fantastic. Will Ford or GM do that? I don't think so, and I think that's key, is business to consumer, not business to consumer. You take out that middleman, you get more margin, make it more profit. And Tesla's doing it.
I definitely understand with what you're saying, and that's kind of what I was kind of highlighting. Let's just say the difference between Occidental versus Exxon or what have you. I mean, I think what people need to do is, if they're down 40-50% on a position and they still believe in that organization, like I'm down 40-50% on my U.S. bank, my Bryn Mawr Trust, which is a small regional bank, Wells Fargo, and I believe in all three of those. And so I've been investing steadily into those positions with full confidence. And I guess we'll see at the end of the light what ends up happening if it believes that it's actually going to pay off. And I also agree with you on GM as well. Well, you didn't necessarily say invest in GM, but I personally agree with you on GM. I think, well, sorry, I just rescinded and then
GM and Ford. I am more of a GM person, but some people like Ford. I just think if you're going to get the one, now's the time to get them.
I think in the long term, GM's making the right moves, and so I'm going to be a continued investor of GM, and I do believe that they're down now. I think it's going to get worse. So they've already suspended payouts, and I think that as they continue to invest show more and more earnings in the future, let's just say 1 or 2 quarters, I think it's going to continue to get worse, especially as delinquency goes up and delinquency in loans go up, and less people are going to be buying cars. I think GM is going to be one of those companies that is going to be hit for a year or two. And so I think it's too early to tell on GM, but as somebody that's investing monthly like myself, I'm going to keep investing monthly into companies like that, like GM, and being able to double down. But I think it's all very dependent on what people have in their portfolio. The stocks that they're investing in that are 40-50% down could have been, let's just say, awful companies to begin with to invest in. I mean, people might have been investing in, say, AMC Theaters, and I don't think that was a good company to invest in the beginning at all anyway. So if that's down 40-50%, they can easily, say, invested in something like a Wells Fargo, JP Morgan. They're going to outlast that, let's say, that AMC Theaters investment, and they'll be able to at least get their money back, at least with higher confidence. I mean, can't guarantee anything, but I have more trust in a Wells Fargo, JP Morgan bank than I would in, say, an AMC Theaters. I think AMC Theaters, there'll still be theaters, don't get me wrong, but the name will change hands and the stock would go to zero faster than, I guess, I would anticipate that Wells Fargo and JP Morgan would. So it's all very dependent on, do you believe in the long-term longevity of the stock? And so, unfortunately, sometimes I think people will look at a stock going from $10 to $20 and assume that that is really what's happening. No, it's people are buying an organization and saying, no, it's worth $250 billion today versus $500 billion tomorrow. I mean, that's really what's going on. And then everything gets divided by the shares outstanding. And so I think sometimes people just get up in their heads too much about with respect to what the price is for the share. What I think they should be looking more at is the fundamentals of the organization. As my perspective, there could be technical traders out there that completely disagree, and will disagree, in fact. And I honestly think that they should be looking at, okay, at this current share price, which means the company's evaluated at $5 billion, $10 billion, is it a worthwhile investment at the moment with the future potential that it might have? And so that's this way I look at it, and how I'd answer the question personally. So,
Well, I think it's, especially a newer investor, I think the fundamentals is hard to grasp, like the qualitative analysis. I messed that up, but looking at the qualitative perspective, I think a lot of people it's really hard. I think for a new investor, they struggle with that. But I think a lot of them too are trying to. Go ahead. Hello?
What's that?
Oh, okay. Yeah, I think it's a big challenge with that. I never really liked banks, to be honest, but I've been going heavy in banking because I know that banking, one, it's part of the economy. You see how all the government's working with the banks right now.
Yeah.
Everything's going on. So it's integrated inside of the economy. You can't really, at least now, and I don't see it ever changing, where the banks can be non-existent. Will brokers become more like a bank in the future? There's a very good chance. The banks are also so big that it's hard to take. That too big to fail. That's happening a lot in the U.S. now, where if you're a big company, you kind of don't have to worry. Get as much corporate debt as you want. The government's not going to let you bail. Like Boeing. I don't know if you own Boeing, nothing against Boeing, but they just don't want to lose an airline. There's a duopoly right now. United States want to lose it, so no matter what Boeing does, the government will bail them out. So I mean, it might not be a bad stock if people are looking. I don't know how it's going to be for a dividend investor. I mean, right now there's no dividend. I don't know when there'll be a dividend, but for growth, that's probably a good stock. I mean, it's too big to fail.
No, I mean, my perspective, I purchased Boeing personally. So you mentioned, I don't know if you invest Boeing. I do. So Boeing first came onto the scene for me, I would say in 2016 when it was about $110 a share back in February of 2016. And I wanted to buy it then. I didn't have the cash, or at least my perceived cash. And ever since then, I've kind of been kicking myself. So now that it's kind of back down in that range, I started buying at 160, bought more at 130. I think I bought some in the 96-ish range. So it's not a big position by any means. I think it's about 27 shares at about $130 average, 136 average, or is that my Visa? But it's in the 130s. So $3,000 or so. So it's not a very big investment, but I'm investing in that fully knowing that they were going to cut the dividend, or anticipated that they would. And that in the long term, it was a company that I wanted to own. And I would be willing to wait, 2 to 3 years for them to potentially reinstate the dividend, because I know that they were growing the dividend pretty rapidly. And I think that once they get things back up and running, knowing that they rely so heavily on the U.S. government, and that's probably not going to go away, and as well as they're one of the two bigger main aircraft providers in the world between Airbus and Boeing, that I was willing to, I guess, gamble, as a simple term, that they would continue on as an organization. And I didn't think that they were in dire of a situation enough where they would need to, say, give money or get money from the government, kind of like what GM did in 2008, where they were kind of bailed out. I thought that people were in the same mindset as I was with Boeing, where they could go to the public markets and get debt, which is exactly what they did. They got $10 billion of debt issued for their immediate liquidity. So that's kind of my mindset. So I kind of play multiple different ways, right? I mean, I kind of want my dividends now, but I also want future growing dividends. And I'm not going to sell Shell either. I believe long term in Shell, and I think that they're a good company to own. So did I own them for the dividend? Yes, partially that was why I own them, but I also invested in Shell because I believe in their long term vision, and I think that they're going to be a huge energy company, not just an oil and gas company, in the long term. So I think they are holding themselves as the industry leader for energy. I think even sometimes more so than Exxon. And I think that they will help lead the energy transition from oil and gas to lower carbon energies, which is why one of the main reasons why I invested in Shell. So every single position I own, most of the time, I would say, sometimes they're not really fully have a good story or reason why. But Boeing, I kind of answered that one. Shell, I kind of answered that one. So every story or every position that I have a position for a reason. One, because it's something I want to have an investment in, and then two, because I have some sort of position on it, whether it's a verbal position, what my thoughts are on it, and where I think the company might be going. So that's me. That's why I invest in some of those companies.
Well, I appreciate you pulling up Shell or bringing up Shell because I own Shell as well, and I was getting it for the dividend as well. Now, it's actually a very expensive company. I don't know if I'm going to sell it right now, but when I go up, when it goes up.
Sorry, you're cutting in and out. I don't know if it's me or if it's.
Yeah, I don't know either. It could be me. It could be you. But I have Shell, and that's good you brought that up. I was holding it for the dividend. I did believe in the company, but one of the things I believed in the company is they really talked about rewarding the shareholder. I think it was a few months ago when oil was $50 a barrel around there. I think it might have been high 50s. They were talking about returning so many billion to shareholders through buybacks and dividends. And it sounded great how much they cared about the shareholder. But now I kind of wonder if they just say what you want to hear with how big they slash the dividend. I don't know if that's a concern for you because I don't know if you read about that. They were supposed to return, I want to say it was like 12 billion shareholders. It was something like great for a couple years or something.
Mm-hmm.
I thought that was awesome. I said, you know what? Company has a lot of cash flow. It did seem like a leader in the industry, like you said. And I really think on the company that actually cares about the shareholders. We have a lot of CEOs that just care about themselves and don't even care about the business. And it's not. They're just worried about getting their bonuses and things like that. So they'll do buybacks and then sell their shares and do stuff like that. But Shell seemed like they really cared about the shareholder a lot. And with the cash flow statements and how their earnings went and everything else, they really didn't need to cut the dividend, but they did.
I agree.
So they kind of reminded me of Ford in a sense. Anytime Ford seems like they smell trouble, cut the dividend instantly. I mean, the CEO's coffee gets spilled on the way to work. Now he's got to take it out of the company, cut the dividend. I mean, this kind of like seems like that's the way Ford operates. So I was very shocked that they did do that, Shell, and it makes me kind of skeptical about the company now. And I don't know what your thoughts are about it. I know you think they're a global leader, but do you think they really care about the shareholder? I mean, will they really pass Exxon?
So the way I view it is they care about the long-term investment philosophy of their organization. So when I look at Shell, and I had to be careful because I do work in this industry, and I don't want to tell people specifically who I work for and who I work with. But I'll just say very simply, I have worked with people at Shell before. I've worked on Shell assets before. I don't work for Shell, but I have worked with them before. I like the way they do business. I believe when they say things. But I think that the oil industry at the moment is in a very interesting place. You have 5 or 6 major companies that have a large ownership of the non-international, government-owned oil companies, I guess you could say. So not like Saudi Aramco or anything like that. And you also have a population that wants to transition to lower carbon energies. So people want their cake and they want to eat it too, unfortunately. And before I continue, I guess I'm going to say some things that are my opinion, in my opinion only, not the opinion of my companies. Or company that I work for. So, you can't go back and be like, this is what X company, if you ever find out who I work for. But my thought is people want their cake and they want to eat it too. So they want their energy, but they want to make sure that that energy doesn't destroy the environment. I completely understand that. I get that. What I think that is happening in terms of Shell is I agree with you 100%. I looked at their cash flow statement and I actually came up with a funny meme that I wrote or made. And I thought it was pretty funny. But let me see if I have it here. But anyway, I don't know if you've seen the Pablo Escobar meme that he's looking off in the distance. But anyway, it was basically like a photo of Pablo Escobar looking off in the distance, being like me wondering why Shell cut the dividend. So I agree with you 100%. The cash flow statement looked good. They had about $14 billion. Was it $14 billion in cash flow for the entirety of the quarter? But then they cut the dividend, which only cost them about was it
2.5? Was it? Or,
what's that?
Was it? I thought maybe 2.5 off the top of my head, but it was like 4.5.
Yeah, 4.5. So they paid $15 billion in dividends in 2019. I know that, for example. So I guess a little bit less than 4. So they're cutting basically $2.5 billion out of that every single quarter. So what I can understand is, and the thing that troubled me is that I know Shell and BP for the London pension fund are about like a sixth of the income that the pension fund holds, right? So I thought that Shell cutting the dividend is huge because they're listed on the London Stock Exchange as well as the U.S. exchanges. But huge amount of London money or UK money is invested in Shell, and that's a huge hit to pension holders in the UK. And I don't exactly, I'm not a UK resident, so I don't know how that really works, but I know it's a huge hit to at least the people that are expecting pension money. I don't know if that means their income gets hit exactly or what, but I know it's a huge proponent of the UK stock exchange income comes from Shell dividends. But what I think the big issue is at the moment is you have this huge transition that's going to occur over the next 10 years. So you have two camps. You have the camps of the super majors that think that we need to cut company emissions, CO2 emissions to net zero by 2050. That's the Totals, BPs, Shells of the world. And then you have the Chevrons and Exxons of the world that are looking at the camp where they say this is a fad in the world, and I think that we're going to keep producing oil and gas for the next 30, 40 years, and people will still want our products in 20, 30, 40 years. So I agree with both camps. I think that in 20, 30, 40 years, people will still be using oil and gas. You have to think that the people that want to transition to, let's say, these lower carbon sort of energies and using them are a little bit more advanced in potentially their economy than, say, some of the other folks that are kind of out there. So think about people that are a little bit way away from certain infrastructure and stuff like that. So the European economies are rather mature compared to, let's say, some of the South American economies that are just starting to get growing, right? And starting to get to the point where they're industrialized and really, I guess, globalized like some of these other economies. That's my point of view, not anybody else's. So you'll have a lag in companies that want to transition to lower carbon and use that lower carbon immediately, like we are in, say, the United States, as well as a lot of places in Europe. But you'll have places where people will still need to use oil and gas because, one, the infrastructure is already there, and two, they're away from, say, the closest infrastructure piece. You think about it, in solar, you're going to need to be connected to a grid. People all the way in Alaska might not necessarily be connected to a grid, or very distant wilderness, Arctic Canada might not necessarily be connected to a grid. So they need to transfer their fuels to get themselves to either running a generator or what have you. So anyway, back to kind of what I was saying. So you have the two camps. people that want to transition to lower fuels or lower carbon fuels, people that want to stick. So my thought with Chevron and Exxon, and I still haven't fully comprehended where their strategy is. The way that a lot of people are predicting oil and gas growth to go in the future is it'll probably continue to grow 2 to 3% per year. Keep in mind that a lot of this is pre-COVID coming into the scene, and that COVID really changes things in the near term because obviously people aren't driving as much, and I think it'll take some time for things to kind of get back to where they were. But pre-COVID, things were kind of growing at a 2%-ish range for oil and gas, a little bit higher for gas, a little bit less for oil. And that, at the moment, we produce about 100 million barrels or so a day, and people are generally using 100 million barrels. So that would mean next year we'd go from 100 to 102 million to 104 million over the next 2 to 3 years, pre-COVID. That would slowly get to the point where it levels off probably in 2030. And some people say it'll start leveling off in 2040 as the transition or the growth in the renewable sector, whether that's wind, solar, what have you, continues to grow at, say, 10 to 20% over the next 10 to 20 years. So my thought is you have these oil and gas companies like Exxon and Chevron knowing that over the next, let's say, 10 to 20 years, there's still 100 million barrels to 110, maybe 120 million barrels that need to be coming out of the ground based off of current projections. Now, of course, somebody else comes in with new technology or margins change like they are now with COVID. That can change the trajectory and, of course, change how profitable it is to continue to produce, say, a certain amount of oil. So keep in mind, margins go down. It's going to be cheaper oil and gas products, but it's also going to mean that less people are going to be able to invest in those because they make less margin. So price of oil will eventually kind of come back up as people want to buy things that are cheaper. Demand will then go up because more people will be able to buy it. But at the same time, the margins are horrible. So kind of like what we are, right? And same thing what happened in the early 2010s. There was plenty of oil and gas. A lot less companies were able to continue to maintain at that price. The demand kept growing while supply kind of remained flat or slowly continued, where demand was kind of exploding between 2005, 2006, all the way up to 2008 before the recession. Oil skyrocketed to $140 a barrel. And then boom, recession, demand, just like what we're seeing now, got destroyed. And then price went down to $20 a barrel. And then the cycle kind of continues. It's cyclical, just like anything else. My thought is Chevron and Exxon are thinking and sitting there saying, well, they know that this demand isn't going to go away overnight. And what they can do is try to make their I guess, investment bases as strong as possible, continuing to maximize their margins, just like they have been over the long term. And I think that's evident with what Exxon's doing with trying to increase their investment in Guyana and Permian Basin, and having huge, high margin, low cost to lift in those basins and continue to expand those because they are low cost, huge basins to kind of become the breadwinner and the front runner in those basins. Obviously, they're the breadwinner in Guyana, and they're continuing to grow their investments and acreage in the Permian, and they're far from done. And so my thought is they're trying to get a huge amount of oil coming from those. In the near term, it'll be about 2 million barrels just from those two basins alone, very low cost. And so hopefully that will be for the long term. They've already found 8 billion barrel recoverable in Guyana. And so I think Chevron's in the same camp. They're going to try to do something similar. Are they going to do it as well as Exxon? I don't know. I don't know much about Chevron like I do Exxon and some of the other majors. The other camp is the Shells and BPs and Totals, and I don't know much about ENI of the world, where they're going to try to transition to the low-cost fuels over time. As it
now, what do you mean by that? That's because I understand exactly where you're going with Exxon.
Yeah.
And to me, at least, you're basically like an expert, and I want to understand the sector more.
Sorry, I don't know if it's me, but you're
Oh, it's
cutting in
probably
and out.
me. But I want to know more about the energy. So I see you kind of as an expert. I know you're not claiming to be one, but I don't know anyone else who works in energy. But I understand your Exxon, and I do have stocks in energy, and I was thinking about increasing them, doubling down on them, but I wasn't sure. I mean, I was disappointed in the Shell, and then I was wondering if any of the other ones are going to follow suit because Shell didn't really have to cut it, and they cut it anyways. Is Chevron and Exxon going to follow? I did own Oxy, and do a lot of options with it, so I made quite a bit. But I still lost way more. For good reason. I mean, there's definitely the CEO. I swear couldn't make any more mistakes than she already has. But how do they? How is I'm a little bit confused how Shell's getting that's what kind of fields are trying to do.
Sorry, I heard you up until Oxy and the mistakes that the CEO made, and then you lost me as you went on.
Oh, I was trying to say I don't understand how Shell is going to zero emissions. If you could maybe give me some insight on that. How is that? How do you so they don't plan on using oil at all, or how do they get to the zero emission? That's what I'm a little confused about.
No, I understand where you're coming from. So one is as a transition. So they kind of look at it from a 2019 basis, and there's multiple different tiers. And I have a good graph, but I can't unfortunately share it because it's I don't want to say company proprietary, but it's company proprietary. So a lot of it is considered in tier 1, tier 2, tier 3. So there's tier 1, which is like our direct operations, right? So whether that is the facilities that say Shell or BP or Exxon or any of these oil companies have, they can do things like flaring, which is directly putting CO2 and things like that into the atmosphere as they just try to keep their tanks and their facilities pressurized. And refineries do that too, so it's not unique to specifically oil and gas, I guess, offshore upstream facilities. But what they can do is try to reduce that as much as they can and undo unnecessary flaring. They can either do that or re-inject some of that gas back in. So there is some places of the world where they can transport oil because it's a liquid, but they can't transport gas because it's a gas. So think of places that are kind of in pretty remote areas. So think like, let's say Alaska is a really good example. And maybe even some parts of the Permian as well was a recent example where they were able to get the gas out, but they weren't able to really they were able to get the oil out, but they didn't have the infrastructure for the gas. So a lot of companies were flaring in the Permian because the gas pipelines weren't coming up as quickly as the oil pipelines. So part of that is trying to keep that under control. Then there's things that you can do to offset, right? So you can re-inject some of that gas, whether that is to help improve recovery from initial oil and gas wells. Let's just say because I don't want to get too technical, but basically if you inject gas, you might be able to get a little bit more oil production and keep some of that CO2 specifically in the ground and not produce it into the atmosphere. So you're taking CO2 from the atmosphere, you're re-injecting it, hoping to get more oil and gas to maintain pressure in the reservoirs. And there's some other kind of reservoir engineering or petroleum engineering technology that kind of goes into it, and chemical stuff as well, and chemistry. But in simplest form, you're maintaining pressure and hoping to keep CO2 in the reservoirs, bring oil out of the reservoir so you can use it for fuel. So that's another way you can do it. And another way is to just reduce the amount of carbon intensity that is going into things that we do on a day-to-day basis that we don't think about. So things like cement, for example. Cement is, I think, the third largest, creating cement around the world is the third largest carbon emitter in the world after the United States and China. So if you were to reduce the amount of CO2 that is emitted from producing cement, you will then, in, I guess, perspective, or maybe not perspective is the right word, in proxy, I guess is the right word, reduce the amount of emissions coming from the world. So there are new technologies that cement making organizations are taking to reduce the amount of carbon emissions that they're doing, whether it's changing the way that they bake the chemicals so that way they don't need to heat up as much, because they have to heat it up to like 1200 or 1400 degrees Fahrenheit to sometimes make these cements. They can sometimes maybe burn at 600 degrees Fahrenheit, so reducing the amount that they have to use in terms of energy to burn those chemicals and make sure that they bind appropriately with the lye and all that other junk. And then also, I forget what the second part of it was, utilizing less, I forget what chemical is in cement. I'm going to get butchered if any of my petroleum engineering buddies are listening to this, but there's like lye, sand, and another chemical that you kind of put in to make cement. And if you change the ratios a little bit, you don't really reduce the strength of the cement, but you reduce the carbon intensity of the cement by a significant portion. And so taking those two steps can help reduce the amount of carbon within cement, but also not really deteriorate the strength of it. And so it's simple things like just thinking about that throughout the entire chain of the entire industry, and not just oil and gas, but throughout that you can start to really chip away. And so it's not necessarily removing, like entirely being like, hey, we're not going to produce oil and gas. It's offsetting. It's trying to make things more efficient. That's one, probably a better way of doing things, making things more efficient in terms of one, lowering costs so we can increase margins, but two, better for the environment. So it's kind of a win-win. And then another part of it is also transitioning from just strictly oil and gas production as a whole to lower carbon businesses, whether it's solar, whether it's wind, whether it's, other technologies that we haven't thought about, hydroelectric.
But Shell's thinking about going to wind and solar and things like that?
Oh, for sure. I mean, I would say Shell, BP, Total. I don't know much about ENI, but they have huge renewable portfolios. And I encourage anybody that's watching. They're actually probably competing, I would say, easily with the NextEras of the world, the Southern companies of the world. I mean, if you want one of the larger portfolio holders of solar, it's actually Berkshire Hathaway. But unfortunately, the only way that you can invest in Berkshire Hathaway is buying Berkshire Hathaway. You can't buy BHE, which is Berkshire Hathaway Energy, on the open market. You have to buy Berkshire Hathaway, and that would mean you buy Dairy Queen, you buy all the other companies that come with it. So not a horrible investment by any means, but it's not a direct investment. So it's really interesting what's happening now. And so kind of going back, and hopefully it's a good explanation. I don't know everything about it, so I appreciate that I'm leaving out a huge amount of details, and hopefully nobody gets upset with me by that, because I'm still kind of trying to learn it as well, because I did go to school for oil and gas, not for energy management or anything like that. So I'm trying to learn to better myself. But the huge thing that Shell, I think, has now is they have $2.5 billion extra of cash flow that they no longer have to pay to shareholders. And so while as a shareholder, I was originally disappointed by the 66% reduction, I do recognize that Shell already, in my opinion, if you look at the portfolio that they built on the website, and BP for that matter, and Total, I think as well, they've already built a hugely extensive renewables portfolio. And while I think that margins for oil and gas products will continue to be impacted in the near term as well as in the future, that $2.5 billion that they now have per quarter, so $10 billion a year in free cash, can help as a buffer in that transition to these newer companies and lower cost companies. I would say at the moment, easily at $50 to $60 a barrel, so 2-3 months ago, I need to recalibrate my mind for how returns and stuff look at this in this new environment at $20 to $30 a barrel. But at $50 to $60 a barrel, I would say it was still a better investment to invest in oil and gas, because you could find things that are returning 20, 30, 40% on your money and sometimes really quick projects that'll come back in a year that'll pay 100, 200% within a year, right? But of course, those are small projects like do this well, drill that well. When you talk about huge companies that are billions of dollars, we're talking about $1,000 projects or $1 million projects, not $1 billion projects. When you get to the $1 billion projects, you might be looking at things anywhere between 10 to 30% sort of returns, which is high quality. But when you start thinking about what the renewable returns look like, at the moment, I would say they're probably high single digits, starting to get into the mid-teens. And so at the $50, $60 a barrel world, it would make sense to continue investing in those oil and gas assets where you can get things like the 1,000% returns, 200% returns for spending $1 million, or if you're spending $1 billion, $2, $3 billion, the 10 to 30% returns. Now we're getting into the world potentially where at $20 to $30 a barrel, or even $40 a barrel, if you're staying within this range, that 8 to 15% range that you kind of had for solar projects or wind projects now starts to look attractive because the margins and the returns that you were expecting to get at $50, $60 a barrel have now gone away because you're not investing at $50, $60 a barrel anymore. So my thought is Shell said themselves, they were able to withstand 2014, and I think a lot of the big oil companies were. 2014, when oil went from 100 to 80 to $100 a barrel, kind of going back and forth, down to 20, back up to 30, and then kind of eventually come back up to 50, 60. Now you're getting to this point where you're going to have demand destruction for the next year to year and a half, and you have political wars going on between Russia, Saudi Arabia, the United States. And in my opinion, it's like, well, margins are going to continue to be hurtful for oil and gas for the next couple of years. So small, large independent companies like Oxy's, and Oxy might turn out okay. I'm not going to say it's going to go belly up, but these other smaller.
If it does, what I was thinking with Oxy, worst case, if it does go belly up, I think Chevron will buy it. So you won't. So as a shareholder, you won't go to zero. You'll just end up with some Chevron stock.
But
I don't think anyone's just going to let it go to waste, and no one's going to buy it.
The big question would be: does Chevron wait to buy it from the banks and the bondholders, or does Chevron help Oxy and buy them out beforehand?
So I would assume beforehand, especially that CEO is going to want to cut. She don't give. I feel like she doesn't care at all about the company whatsoever. So I think she would definitely do it before, as long as she's got a sweet deal enrolled in it.
For sure. I mean, they would want to, but it all depends on what Chevron thinks. I mean, if they think that they can buy it from the bank for 50% of what Oxy is willing to sell it for, then why would Chevron make that deal? They'll just buy it.
Competition, I think.
Yeah,
if it goes to the bank, you got Exxon and you got Total, BP, Shell might want in on it. Other companies could get in on the deal if it goes to the bank.
But I agree with you. So, but it all depends on when that deal is done. So if it happens before they declare, whatever, I don't remember if it's Chapter 11 or Chapter 7. Chapter 11, I think, allows you to restructure. Chapter 7 means you're going straight to the bondholders and you're not restructuring. You're straight up just saying, hey, we're liquidating everything. And somebody can correct me in the chat section there. But if you're going Chapter 7 and, that means your stock is basically worthless. But if they do Chapter 11 bankruptcy, Chevron can come in and still try to get everything before they kind of restructure everything. And then that's when your company name would go from Oxy to Chevron. But if they go Chapter 7 and then Chevron buys it from the banks, that's a different story. And then you're essentially your investment goes to zero. And then you don't get the opportunity for it to go from Oxy to Chevron because it goes from Oxy to zero. Does that make sense? Or am I wrong on that? I could be wrong too.
I mean, it does make sense. I wanted to ask you another question, Matt, because from talking to you, I think I'm understanding energy a lot better, and I appreciate it. I don't know if other people are.
No, I think the thanks is to you because I've thought about it internally, but I've never talked about it out loud for this long. So this has really been a phenomenal opportunity to me to kind of build my thought process and articulate it better.
Well,
So I appreciate it.
let me try to talk to you from an investor speculative play on energy. Give you some scenarios, see what you think. These are the things that came to my head from talking to you about it. You're suggesting that the renewables, in a sense, is safer, especially when oil is this bad with what's going on. Now, as a speculative play, what I believe is I looked a little bit into renewables, not as an investor, but just renewables in general, and they seem to be they're not here. I know there's a big push, from certain parties where they want to, a green deal and they want zero emissions. It seems like no matter how hard you try today, technology is not here. I mean, for solar, you need a big battery advancement. Lithium's not going to cut it if you really want to rely on solar. And I think the wind's very stationary. I mean, it's very locational. You need to have that perfect location. And you also need to they take up so much space to wind, so that's not ideal either. So I don't think there's a renewable right now that's really profitable, like you stated, with the high single digits versus the oil. But once the renewables do become profitable, once there's these new technological advances in society where now they're profitable, couldn't, in theory, Exxon and Chevron just switch over then? Like right now, is it really kind of a waste of money to try to go to renewables when the technology is not even there for renewables?
No, 100%. And this is kind of the internal argument I've been saying with myself, because at the moment, and I love this conversation because I was having this conversation with a coworker yesterday, is I was trying to work this out. Because at the time being, Chevron and Exxon are saying the returns aren't there for renewables. We think this is a fad for the time being, and that people are just trying to save face due to the 2015 Paris Agreement. And we're going to keep making our cash flow from oil and gas assets, and that's it, what it is, right? Then you have these other companies, granted the more European companies. So Europe is, generally speaking, a little bit more on the left compared to, say, the United States when it comes to renewables and things like that. And I hope nobody gets upset with that. I think that that's an honest opinion, and an obvious opinion. But I agree with you 100%. I think what you're saying is something that I don't know, and I'm trying to work out in my head is, I don't think that Exxon's sitting there saying, hey, because what I view it as is, and I think Jim Cramer explained this really well, is oil and gas has kind of become the new cigarettes. And what I mean by that is revenues are going to continue to be impacted heavily over the next couple of years, if not until 2040, 2050. And what you're going to see and try to have people do is try to maximize the operating margins that they get from those revenues as you have volumes kind of flatline or decrease over time. So kind of like cigarettes, how less people have been smoking, but revenues have kind of stayed flat, if not gone down. And the way that Altria Group, Philip Morris have continued to be able to go into and keep building earnings per share is by increasing their margins, increasing the price per pack that they sell their products at. I think that is honestly what's going to happen when it comes to Exxon and the Chevrons. But exactly kind of what you're saying is, I don't know if eventually what they're saying is we're going to wait. And I have a really good slide for this, and I hope people appreciate this, because I saw this the other day and I think this is it. Yeah. And I was like, holy crap, this is kind of cool. Exactly what you're saying is the technology isn't there yet where it can 100% compete with the margins that you might be getting from oil and gas, especially if you believe that oil and gas is going to go back to $30 to $40 a barrel to $50 a barrel. And that hopefully it continues to decrease over time. I agree with you, and that's what I don't understand. So at the time being, the investment decision for people investing in these oil and gas companies need to look at, in my opinion, is, are you wanting to invest in a company that might be too early, right? So in a really good example of this is Netflix versus Disney Plus, right? You have a company that didn't become the frontier. Granted, you can't say that Shell or BP are the frontier companies, because obviously they're trying to build their portfolio just like everyone else in the United States is trying to build their solar portfolio. So it's not like it's like as big as a Netflix. There's no monopoly owned. But think of it as like a Netflix that has 150 million users, and Disney coming out being like, hey, they made this really profitable. We have great intellectual property. We're going to come back now that we know that it's a profitable business and it's something that people enjoy. We're going to create our own product, and we're going to get 50 million subscribers within the first 6 months.
Well, Disney, though, I think what Disney does, though, that separates Disney from Netflix and other companies is it's business to consumer. Again, it's focusing on no middleman. That's huge profit.
I agree.
So that's phenomenal. If you notice with their theme parks, with only thing I think they outsource are toys. Everything else is business to consumer. There's no middleman. So I think that's phenomenal for profit, no matter what business it is. But go ahead. I'm sorry to interrupt, but I just if anyone
it's reasonable to look at. But what I definitely want to share with people is exactly what you're talking about, because I agree with this. So this was an Xterra. So I have a friend and coworker that I talk a lot of oil and gas with. So if I'm ever getting fed up with my day job or trying to argue with someone and I need to take a break, I'll talk to him about investing, kind of like what I'm doing with you guys right now. So him and I are talking, and I'm telling him about how I'm investing a little bit into Southern Company to get my utilities up. And him and I were talking about, is Southern Company or NextEra the better company to invest in for renewables, right? Mm-hmm. And so I came across this slide, and I think this is probably one of the best slides I've come up with. And so this is just off of their 1Q. And this is like, I was surprised. Like, this thing's like 50 slides long for like an annual report, an earnings report. And I thought that was crazy. But this is a really good slide. But what you're looking at specifically is on the left, you're looking at basically the cost to get electricity from wind energy. And on the right, you're looking at the cost of getting electricity from solar. And on the scale on the left, what you're looking at is the dollar per megawatt hours that you're getting. And so I know it's hard to kind of like quantify what a megawatt hour is, but what it has is dollar per megawatt hour. So in the case of wind energy, the scale goes from $0 to $70 per megawatt hour. And in the case on the right with solar, it goes from 0 to 160. And you can look at basically what's happened over the course of from 2010 to 2020. And it's showing both for wind and solar going down at about 15% annualized productivity gains, meaning that every year it's either getting more efficient, which is something we'll talk about in just a second, or the cost of labor, materials, and just efficiencies that it costs to just make those things is getting 15% cheaper. And I think it's a combination of the two. But I think one of the coolest things is, and it goes back exactly to what you're saying, is it might not be profitable right now for, say, a company to transition from oil to renewables. But if you wait, and it kind of goes back to like the AT&T versus the Visa kind of discussion we had, if you think that you're going to continue to go 15%, then maybe next year it's another 14% down in productivity gains. And then the year after, it's going to be like 10% or what have you. At what point is that crossover point going to happen where it's more profitable to be investing in renewables? And do you want to wait to that point? Because just like oil and gas, you have to keep in mind when margins are high, your contractors are going to try to get more money from you. When people are trying to spend more money. So when everyone and their mom tries to go to wind and solar technologies, the contracting costs are going to inflate, just like with anything else, right? Demand, cost and supply and demand. Like right now in the oil and gas industry, I can tell you, the companies like Baker Hughes, Schlumberger, they're hurting bad because everyone's cutting their capex. And when they cut the capex, that means that the revenue for Baker Hughes and Schlumberger and Halliburton get cut as well. So it's a tough game to be like, well, do you invest in, say, the Exxon, the Chevrons that for the next 5 to 10 years they might be focusing on oil, and wait for in 5 years to start transitioning to wind and solar? Or do you go with somebody that is kind of doing both, right? They're kind of trying to balance like, okay, it might not be great to invest in renewables right now, but we're going to be getting our renewables. So we have all the contracts kind of in place already. And so by the time things start to get really productive, because it's going to get better, 15% looks like every single year where we do another project, if things kind of keep up with what they've been, then, you know, every single year that we're in it, we're going to get 15% more by investing 15% more. So we're going to invest 500 million this year. That'll get us X return. We invested the same 500 million next year. It's going to get us X plus 15%. You know, I don't have the answer for you, but I know exactly what you're talking about, and I think
Yeah,
it's
because
phenomenal.
it's almost like, you know, if you went with Exxon, let's just say, just speculative, and you go with Exxon, and what happens is they're just killing it in profits because they're going all in on oil. Especially Exxon's doing a whole bunch of projects. They're supposed to get by 2025, I believe they're supposed to be an insane increase in revenue. And if you get new technology, like I believe, I'm not 100% sure, I could be totally wrong. I think they're talking about a solid state battery. I think that's what they were saying, something like that. A big advancement in batteries. If something like that happened, now solar becomes way better. How easily could Exxon just jump into solar like fast? Can they get in the game really fast? That's what I wonder. How quick they'll have all that cash and capital. Well, I guess it really depends on what they do with the money. But if they're smart and have all that capital saved up, can they just jump into solar full force and be right there with Shell?
You're not wrong at all.
That's what I don't know though if that's even reasonable though.
No, I mean, you have to think. I mean, I'm kind of going off the fly, so I appreciate that, and I can't really see the screen all too well because I have my phone kind of blocking it. But let's just look at like what NextEra stock is currently worth. Crap, sorry, it kind of disappeared on me.
I wanted to. You got time to talk? Is there other people waiting? I don't want to hold anybody up.
No, I think everyone else ran away. Oh crap! NextEra is like
one thing I wanted
million.
to bring up though is cigarettes. I think cigarettes is kind of interesting. I invest heavily in cigarettes, and I think what they don't tell a lot of people is I'm almost positive. You know how technically there's less smokers every year. Mind you, I feel bad for tobacco companies. That's the only business, probably in the world almost, that gets attacked every single day so hard, getting all these taxes put on them, everything else. And I don't know why they get taxed so bad because they're providing a lot of revenue for the government. But they care about their shareholders, and they give out a lot to their shareholders because if they don't, the government will take it. They'll raise more taxes. So they try to keep their payout ratio higher so there's less the government will take, hopefully. If they sit on too much cash, the government's going to want it. But another thing with cigarettes, I believe, is the smoking is going down every year, but I believe vaping is going up significantly. So the actual nicotine consumption, I believe, is still going up. But they say that smoking is going down. That way the FDA is happy. Because smoking of actual cigarettes, cigars, I believe, is going down. But vaping is going up a lot, especially with youth. A lot of people at 18, I mean, now I think you have to be 21 for the vaping. But there's a lot of young people vaping, but they're not smoking. So smoking's going down. The vaping's going up. So I think that cigarette companies could be a hidden gem because they're making themselves look bad when really they're not, and that's so the government leaves them alone.
It's possible. And another thing is, I think a lot of people don't, you know, and this kind of goes back to earnings versus cash flow. And I'm trying to pull up because you kind of mentioned it. The crap. What am I trying to say? You mentioned cigarettes, so I'd love to talk about that because I invest in Philip Morris, and they have a really good slide in here as well. But I agree with you with respect to oil and gas companies. I don't think so. To put in perspective, when Shell reported earnings, their average oil price that they got for the quarter was $50 a barrel. So, granted, in February, March timeframe, we saw deflated prices and negative in some cases in the U.S. I don't think Shell really paid negative prices and sold their oil at negative prices at all, by the way. We can get into that as well. But I think while they had $14 billion of working capital, or not working capital, of cash flow from operations in 1Q, I don't think it's going to look like that in 2Q if things persist.
Oh, that's what I wanted to say, Matt. I'm almost positive, at least for the United States. I can't speak for Shell and BP, but Chevron, Exxon, and Oxy. I'm almost positive that if this trade war doesn't clear up quickly, well, the Saudi oil war, I should say, not trade war, oil war. I'm pretty sure the U.S. will just put tariffs on extremely high, and basically we'll have to buy all our oil in the U.S. from Exxon, Chevron, and Oxy. Well, and the little small companies too, but which then will bring the oil price right back up. So no matter how much Saudi floods, it won't affect the U.S. But basically, we'll only buy U.S. oil.
Yeah, I haven't thought about that. And to be 100% honest with you, I don't know. So I know at the moment the U.S. makes about 12 million barrels of oil a day. I don't know what the consumption of the U.S. is at the moment.
Well, supposedly we're energy dependent. Supposedly it happened like a year or two ago where we can make all our oil we need, but Europe can't. But supposedly the U.S. can. And I know.
Yeah, so we started exporting. I know what you mean. So quote unquote, we're oil independent, or independent rather. We're energy independent rather. So we definitely have enough gas for us, which is why it's so cheap in the U.S. and it's slightly more expensive in Asia. But I don't know the demand figures in the U.S. How much is it? 15, 20 million a day? I don't know. But I know we make 12 million barrels a day. But the reason why we're exporting might just be the fact that specific people or specific refineries or specific chemical makers might like the contents of our oil compared to let's just say the Saudi oil or the oil sands oil. So every single oil isn't necessarily the same. It can be composed up of different carbon chains. So it could have more tar-like chains, or it could have more like gasoline-like chains. Like some of the oil and gas that comes out of the Gulf of Mexico or even the Permian, you could almost, jokingly I say this, but you can almost put it directly in a gas tank and drive on it. Whereas if you were to get it out of the oil sands, you could put it directly on a road and drive on it because it's basically just going to be tar. So that could be one of the reasons why we're exporting. I don't know if that is because we're only using, say, 10 million barrels in the U.S. versus making 12 million. I don't have that answer. I could look it up, actually. But
yeah, I thought we were, but I could be wrong. And I know Trump is he's very pro energy. He's really proud that we're energy independent. So that's why I could see him putting those tariffs on. He's not afraid to do tariffs. I think that's kind of a fact there. So if you place those tariffs on, again, I guess you're looking it up, so maybe you'll know. But if we are completely energy independent, you can place those tariffs on, and now we don't have to worry about it. The oil returns back. None of the oil companies go out of business, and there's not a bailout needed. So it's kind of a win-win for everybody, except I guess the consumer is going to pay more for gas.
Yeah, for sure. So I know Trump's a big proponent of both. I know he likes the oil industry, but he also wants to make sure that the consumer doesn't get screwed, right? Because it's like, I forget, somebody did a calculation and somebody had it in a recent note, but it's like for every 10 cents, the impact to the economy is like, I don't know, I'll just throw out a number. I know it's going to be wrong. Let's just say $500 million a day for every 10-cent increase in oil price. So it's like, yes, you have oil companies that, are losing jobs locally, but what's the balance point between the economy and the major consumers, which is 350 million people, versus, let's just say, the 2 to 3 million people or the 1% of the U.S. population that works for these oil and gas companies? There's a balance, and I don't know what it is, but yeah, I don't know.
I would almost think they just get it back to where it was, $50 a barrel.
I agree. I think that's
everybody survives. I mean, yeah, it's a little bit more at the pump. You're not going to be getting gas. I think here it's like $1.30 a gallon or something.
Well, I'll tell you. So in 2014, 2015, when all this happened, a lot of companies weren't breaking even at $40, $50 a barrel, even $60 a barrel. So when oil prices went down and kind of leveled off in 2015, 2016 to that $50 to $60 a barrel range, people were losing money like crazy. And it took, obviously you saw a decent amount of bankruptcies in the small independent market and things like that. But it took a lot of cost deflation in the system. Your Baker Hughes, your Schlumbergers, your Halliburtons, cutting employees by huge margins and decreasing how much they're charging for contracts to do specific jobs by huge margins as well. Sometimes I've seen up to 50-60% year over year, so keep that in mind. Same job was, let's say, 200,000. The next year it's 80 to 90,000 to do the same exact thing from the same exact company. And so a lot of that happened relatively quick in 2015, 2016. And it's either the price goes back up to 50, 60, and hopefully companies can balance their books at the $40, $50 oil price and, still report good earnings, or you'll have the companies that kind of run at a deficit for a while that can afford it, like your Exxon, Shells, BPs, maybe even Occidental, because now they have a little bit more cash flow coming from, they don't have to pay as much in dividends. And they can withstand it for a while. Granted, I don't think Oxy can, because they're already kind of up to their necks in debt as it is.
Yeah.
But yeah, I mean, that's all it is who can outlast who at a reduced price, or does it get to the point where it gives us some breathing room at $50, $60 a barrel?
See, because that's where it was before, though. Before the whole COVID and the oil crisis. That's why I would think if you got it back to that price, companies were managing at that price.
But it wasn't sustainable. It wasn't sustainable for everybody at $50 to $60.
Oh,
so
gotcha.
keep in mind, right? I mean, initially, everyone was investing in projects. Let's just say projects that could have been economic at, let's just say, the return threshold. Let's say, and I don't want to give out too much information. Let's just say, for instance, the return threshold for a project back in 2013, 2014, when oil was $80 to $100 a barrel, was 50%. So it needs to make a 50% rate of return for us to sanction the project and FID the project, I guess is the right term. And the break-even cost of that project might have been, let's say, $60 a barrel. So if oil went down to $60 a barrel, the returns on that project would be 0%. Depending on if it met the economic thresholds, oil companies might have sanctioned that project. Then you had in 2015, 2016, the price go down to below $60 a barrel. So that project is now running at negative, right? Mm-hmm. And so a lot of companies struggled initially in 2015, 2016, a lot of bankruptcies, a lot of small companies that, just like what's happening now with some of the small companies, think of Oxys, think of, Deep Gulf. No, not Deep Gulf. That's not the answer I'm looking for. Crap. Freeport-McMoRan is a good example of one of the people that got blown off the face of the earth. I was working in the Gulf of Mexico, and I just know they were having fire sale prices for Freeport. Who was another company? I'm trying to think of another company. But bankruptcy is happening left and right in 2014, 2015, 2016. And so what's happened now is you have 2020 people that have survived that, gotten their cost and break-even price and everything back in sync to the point where they're starting to make money. And you can see this if you look at Shell's income statements from, let's say, 2010 to now. You'll see like the drop and then kind of coming back, and then you'll see 2018 was really good for them. In 2019, it retracted a little bit in earnings. And then obviously this year it's going to be detrimental. But I think it's going to happen exactly like it was, exactly what it was in 2014, 2015. This is going to happen, I think, a little bit worse because now we're kind of hanging out at $20, $30 a barrel. It looks like it's going to stay there for a while. But I don't know. I don't remember what we were talking about before we kind of jumped back onto this.
No, you said something about you're pulling up Philip Morris. Are you pulling up the IQOS or something?
Oh yeah, no, I appreciate that. That was a good reminder. I have it. So they have a really good slide in here about Philip Morris, about they have total shipments in here, but then they have heated unit shipment volumes in billions of units. And the basically what they're doing. So Philip Morris now, luckily, and I don't know if I'm speaking 100% because I'm still not, entirely versed in the cigarette space, but obviously they have the Marlboro brands, which is the #1 brand worldwide for most countries, and then they come out with IQOS, which is it's not like vaping, but it's heated instead of vaporized.
And I heard it has like half the harmful chemicals too.
Yeah, so they're trying to get it actually regulated by the FDA, and so far things look great. And Altria Group might actually, they're trying to license it because obviously Altria Group and Philip Morris were the same company at one point, and then
I believe it got approved, and they started rolling it out, Altria, in a couple states, but then the COVID came out. So I believe it's FDA approved in the United States right now. Now they're trying to approve, I believe, a newer model that's smaller and the battery lasts longer or something in it.
So I'm not entirely versed. Was it COVID, or was it the problems that people were having with vaporizers last year, where they had the secondary aftermarket products, and they FDA kind of put it on pause because everyone was getting hospitalized for using like CBD oils and stuff like that.
No, well,
maybe,
yeah,
that was CBD. It was like THC.
Yeah, that's what they were putting in it.
That had like acetone and stuff.
So that was frustrating too. I was a little upset with that because anybody can put anything in those pens. That has nothing to do with the tobacco company. But no, I believe that already got approved. It's just that I'm guessing it's a capital thing where Marlboro, Altria Group, I call it Marlboro. Altria Group doesn't want to roll it out because how much capital have to put out, and also people can't come out. And I believe you have to do all the advertisement kind of face to face, or maybe you do some kind of, because you can't have commercials for it. So there was a way, I think, where with the whole COVID, they can't really get the product out there. That's what I heard. I was listening to a conference call. They were talking about it.
Yeah, I'll have to. Was that on Philip Morris or Altria Group?
It was Altria Group. I got both, but
yeah, I do too. So I'll have to listen to it. I generally just look at Philip Morris because, anyway, I had a chance to look at Philip Morris's, which is why I pulled it up, but I didn't pull up Altria Groups yet, so I should. But I'm trying to think about where it was like the growth, at least in the total shipment. So here's a good example. So cigarettes, you could see in the billions, decreased by from 164 to 157, right? So what is that? I don't know what shipments versus IMS. I don't know what that means, but decreased, right? I don't know what that is. 4% looks like, I guess. I don't know what the 6.7 is. I don't know if that's currency versus prior year. I don't know. But then if you look at the heated up units, it went from 11.5 to the 16.7. So 11.5 to the 17. So, I mean, huge increase, right? 45% or 35%. I don't know which number I'm supposed to look at. But 11 to 17 is a big change in billions of units. So, yeah, I mean, you can see overall things went down.
Yeah, I guess that is true. They did overall go down. But I guess that's just two, but that's not also putting in. Is it also putting in? That's just only showing cigarettes, what they call regular cigarettes. And then that's comparing to heated tobacco. But that's also, they have another segment, which is like their Copenhagen and stuff. Tobacco. I think that falls under another segment. And then the vaping falls under another segment too, I believe.
For Altria Group or Philip Morris?
I would think both, because I believe the heated is only the IQOS, and then they have the regular cigarettes, but then they have the vaping segment, and they have the chewing tobacco.
So I know I'm familiar with Altria Group having the chewing, and in the vaping, I don't know if Philip Morris does. You might know more about it than I do, to be 100% honest with you.
No, I'm not. You probably know more about Philip Morris. I own Philip Morris, but I haven't looked as far into Philip Morris because I own more of Altria Group, so I've been following them a little bit closer.
See, I like Altria Group because it's U.S. and it's got Anheuser-Busch exposure. They own 10% of that. And the wine exposure. They have cigars. They have the smokeless, like you said. And they have the smoke aspect of things. And then exactly what you mentioned as well is the potential for the vaping aspect of things with, and don't they have like an investment in Kronos as well?
Yes, and that's what I wonder about too, because I don't really believe in the whole. I'm not really a supporter of legal marijuana, but it does seem like it's coming. And if it gets legal on a federal level, it's not on a federal level still, but if it becomes legal on a federal level, in theory, the smartest thing for the government to do is regulate it and tax it. Who's best to regulate and tax it? A tobacco company can jump right in, then that's huge profits.
I would agree with you, and I honestly think like a lot of people always think about you know, oh well, you have all these other companies that are going to come out of nowhere, and part of me is like, if you have all these other companies that are coming out of nowhere, and you have this massive logistics giant already built, maybe not logistics the right word, but you have this large tobacco giant with has the logistics, the warehouses, the cure houses, everything set up. Who's to say that they wouldn't just immediately be like, okay, convert 10% of these fields to marijuana, and then they'd immediately be the largest, I guess, marijuana, you know, producer in the world.
But I think it's also regulation though, because think about it. A lot of businesses can't start a business because regulations. So if they put those regulations on, not anybody can just start growing marijuana when it has to be regulated. So you're gonna have some big problems. But Ultra Group, at least I think out of any company in the world, when it comes to tobacco companies, they know how to deal with FDA better than anybody.
Agreed.
Because they're constantly on the battlefield with them. So
agreed.
If it gets regulated, they're gonna have basically a monopoly over it.
Agreed.
So I mean, well, you know, BTI, they'll probably get involved, you know, but in a sense, that's why no one can get into cigarette smoking, I guess, either, because you can't have any kind of advertisement. So if you want to start your own cigarette company up, there's no advertisement. How are people gonna even know about your product? You have all these regulations to even start it up. There's no way you can start a company up.
No, 100%. I mean, I'm being a little facetious, but the only way you know about Juul or tobacco products is if you go to a house party and you're drinking and somebody gives it to you and you're like, what do I do with this? So
yeah.
So yeah, I
Word
agree
of mouth,
with you.
that's it.
You can't advertise it, right?
Yeah. So, and I seen, you know, they show little fake packs where they had like a Marlboro Green somewhere.
I've seen
I don't think it's real, but it's definitely, as an investor, I'm thinking that's a great way to make money. Even though I don't support it, you know, I'm not really a big fan of it. But from an investment standpoint, I think I can make stock would make it's probably like it'd probably be, I would imagine, $100 range if it became legal marijuana on a federal level and it was regulated.
Agreed.
So
yeah, I mean, I don't indulge in those things. I do indulge in a good cigar every once in a while, and I do indulge in some good liquor every once in a while, and so yeah, I mean, some people are like, well, don't you feel bad investing in that? It's like, well, if somebody's gonna have to invest in it, it might as well be me. I mean, I'm not 100% against it, but anyway, that's my thought process on it. But I agree with you. I mean, I fully anticipate that as things kind of get legalized or regulated in the future, that Altria Group is going to be at the front line for sure. I agree with you 100%.
All right, Matt. Well, I don't want to take up all your time. Then maybe someone else wants to jump on.
No, I appreciate it, and I appreciate shedding the light on different perspectives and everything like that. Make sure to keep in touch. How long have you been following the channel, if you don't mind me asking?
You know, I just started watching it maybe a month or two ago.
Okay.
And then I know you keep saying, I know 3/4 of you watch it but aren't subscribed. So you said that.
Hey man, it's, you know, I do it, so it's kind of like a marketing technique, right? So
yeah.
I'm the same way. Like, it'll take me a couple times to be like, I like this guy, I'm gonna keep watching him. So I'll like watch a video and I'll either like immediately subscribe, and this is as a content creator, you know, myself. And then sometimes I'll be like, oh my God, it's like my fourth or fifth time. I love this guy. I'm going to keep watching him every video. How am I not subscribed already? And it literally takes YouTube, like, is smarter than I am, or Google, I guess, is smarter than I am. And they see that I like that guy's video. I might have gave it a thumbs up or something. So they'll put it back into my rotation. And just luckily, I see it again. And I'm like, I like that guy. Let me click on it. And sometimes it just requires somebody to remind me. And it's only gone up. Like, it used to be like 60%. And it's only gotten up. And I think it's just I think it's only like just recently that it's gotten up to the 70-75%. So,
well, maybe it's getting more views. It's probably getting out there more, I'm guessing.
it is.
Videos.
I think it is. I think as my influence grows, you know, I think YouTube is spreading it to more people, and fortunately, which now is seeming to be more women as well, which I'm excited about, because women viewership used to be like 1.5%, and I was super upset about that. So now women viewership is up to like 6%. So,
I mean, I don't know about recently, but statistically, men invested sooner.
I agree.
And I think investing was more a male thing, so I'm assuming that's why. But it's definitely something that should be equal, the way I see it.
I do as well, but I think it's ad driven, and so what they might say, unfortunately, I don't have the answers, but this is, I guess, is my generalized, so maybe I got slapped in the hand for saying this, but you're not going to see men. You'll see. So I'm not going to say that. You won't see men doing makeup tutorials, right? Or not doing makeup tutorials, but watching makeup tutorials. So you'll probably see the exact opposite, where it's like 5% men, 95% women on those. So maybe they're just like, well, finance and personal finance is going to be mostly men driven. We'll have, you know, it focused directly towards men. And sometimes it's just, maybe it's just sometimes the algorithm. It takes a couple times. So I know for me, it's like I'll watch like one video, and sometimes my impressions list or my homepage will get screwed up for like a week. It's like, I only wanted to know how to make like cheesecake like one time. I don't need to see like 80 different videos on cheesecakes now. So sometimes it gets out of whack, and I guess it takes a certain amount of impressions. As you scroll past it, you don't watch it, YouTube will kind of be like, okay, he doesn't want to watch cake videos anymore. So yeah.
Yeah, my biggest pet peeve, I mean, I guess this isn't investing. I probably shouldn't go too far off topic, but there was something that I was against. But I try to look at stuff from both sides. So I watched the video to see if they could find something I was really against, or had a lot of valid points, I feel. I said, maybe they have some valid points. You know, maybe I'm a little bit wrong for being decided. And I looked at it, and some I was really against, and I saw it, and I'm like, yeah, I couldn't find a valid point. But then I get all these suggestions, and I was like, I don't want to see no more of them.
Yeah.
But, well, I appreciate your time, man, and yeah, I mean, it's a good channel. So I appreciate your insight really into energy. That's something I wanted to better. I knew there's a lot of deeper stuff about energy that I don't think a lot of people understand. Like, I do know that I think only like 25% or something, or 35% of actual oil is used for gasoline. A lot of people think that when the gas is going away, so there goes oil company. I don't think a lot of people realize asphalt road features, electric cars are going to be rolling on oil.
Yeah.
And then I don't think a lot of people, like, I think diesel, I think that's going to be a while before those are replaced with energy, with a battery. I don't think there's going to be electric cats going around for a while. I think you kind of need diesel. You really need that power. You're going to have a lot of batteries to try to get that kind of power to run that machinery. I guess you can try to really work the hydraulics, but still, I don't see that going away. I don't see airplanes being on battery electric airplanes for a while. So I don't think energy is going anywhere, but I wanted to understand it better.
And I, like I said, I mean, I'm a petroleum engineer by education. And so, a lot of that stuff is just what I've interpreted being in the industry, and trying to understand where my company is headed, and others that I work with. I do a lot of competitive, analysis and watching what they're doing and trying to understand it. And because I have a different perspective, right? I have as a perspective of where my potential job roles may be in the future, because I might be asked to lead the organization one day, or switch to a different organization as, different departments are changed up or what have you. And so I need to become knowledgeable about it, one, as somebody that works in the industry, and then two, as an investor. So, and I think it's an interesting investment case. And if you get it right, a huge opportunity, because it's the end usage isn't going to change. So people are still going to need to fill up their cars or equivalent or whatever it is. People are still going to need to get to where they're going, which is flying, traveling. People are still going to need to power their homes, whether it's to heat them up or whether it's to cook something on the stove. And people are still going to need to run their businesses. So the end usage is not going to change. It's just how it gets there and what goes into it that will. And I think just like anything, we're going to try to make it better and better. And at the moment, it's going to be just like how we went from coal to natural gas, or coal to oil to now to natural gas. It's just now going from natural gas and increasingly more natural gas to either wind or solar. And I think that eventually it'll come to the place where wind or solar will win out, or hydroelectric as well, or some new technology that we don't know yet. So,
well, I wonder though if there'll still be gas backup. That's what I kind of wonder too. If you had your house was completely powered by solar, would you have gas backup? It's kind of like if there was Wi-Fi everywhere, you could use your phone to call through Wi-Fi. Well, what happens when you hit a spot that doesn't have Wi-Fi? You'd probably still have to have a carrier just for those rural areas or spots where there isn't Wi-Fi for your calls to go through.
Yeah, no,
I kind of wonder.
Because it's also going to take time for people to invest in changing the infrastructure, right? Because just because solar is maybe a better investment case for, say, some of these companies at the moment, and they might invest in those, it's going to take a while for people to either build new homes, transition. So while some people might have their grid set up to their house for electricity, they still might be cooking with natural gas because their stove is a natural gas or a gas stove, right? And so
a lot of people prefer natural gas too for cooking.
Exactly. So unless they change their stove, which is potentially a several $1,000 investment if you're a large business, or a $500 investment to change your stove in your house, would you be like, well, if I don't need to, why would I? So you have that aspect of things as well.
Well, I think initially it'll be expensive because I think with like a lot of people, there's a big push for renewables. Like they want it today, and it's just like, well, the technology's not there, but once the technology is there, then it also has to be affordable. Because when they come out with new batteries, they're probably not going to be cheap. So even though the technology is there, individuals aren't going to be able to try pay for that. Well, they could, but it's going to be too expensive for most people.
I agree, and so it's going to rely on the not mature civilizations, the people that are further along on their economic journey, like the Western Europes, the United States, the Canadas, to kind of lead that front. But you'll still have a lag in some of the other places that don't have the infrastructure built yet, like the South Americas, parts of sub-Saharan Africa, stuff like that, where unfortunately you don't have the infrastructure, where it still doesn't make sense to transition. It might take, let's say, 20, 30 years for it to make sense to transition that gas pipeline that was going to, say, like sub-Saharan Africa, to transition that to power lines that now go from, say, let's just take Egypt, to go to powering those by solar to sub-Saharan Africa. So I agree with you 100%. It's going to be a transition. It's not going to be an overnight thing.
All right, well, Matt. Well, Thanks for your time. I really appreciate the conversation and insight.
No, I appreciate it. And the only thing I ask of you over having a great conversation with you is that you hit the subscribe button.
I already did. I
Cool.
subscribed.
Cool. Thank you. Means a lot. I'll talk to you soon, brother, and hopefully
All right.
catch you on another stream if I continue to do them.
Okay.
Cool, brother. Take care.
All right. You too. Bye.
Bye. We have another special guest. I'm curious who this one might be.
Good evening from the great.
Hello, caller. Can you introduce yourself and what you do as an investor?
Hello. Good evening. Can you guys hear me? From the great white north. It's not so white anymore.
Yeah, man. How you doing?
I'm just popping on because I'm bored and it's late, and I can't believe you're still up here, man. You're almost pulling the Buffett hours right now.
I'm trying my best, man. I'm just trying to follow the man.
Yeah, I don't know what you guys want to talk about later. I just saw some guys cracking jokes to tell me to pop on, so I'm like, all right, I'll pop on, but I don't know what you haven't talked about, what you have talked about.
Yeah.
What anyone in the chat needs to fuel this here. You guys need to fuel this conversation now.
Yeah, I've been going on for a while. I know I've seen some conversations going on back and forth, so I apologize that I've kind of just been going after it. So if anybody still has questions, I'm more than happy to run down that list. And for folks that are wondering who this is, it is Uncle Kyle. Unless you got some other guy that has a really good impersonation of Kyle.
Freedom Finance wants to know what's better, MO or BTI. I don't know. They both have their perks, man. I like both of them fairly equally for their own little details, but I think Matt went over enough of the stuff with MO. BTI is in its own little spectrum though, because it's a European company, right?
Yeah. Can you touch on BTI for a quick moment and kind of talk about what they're invested in? Because I don't know anything about BTI, to be 100% honest with you.
I think they have. I always get my vapes mixed up now because there's Views, there's Vipe, there's Juul, and I think it's Vipe that is owned by BTI. But BTI is dominating pretty good still on the cig sales in Europe, and they also have good exposure to Japan. They got their own little niche built out in that whole sector. That's pretty nice. I don't think they're involved in the MJ sector whatsoever, but they do have that medical space side to them. But I didn't even know they had medical space until I found out they were working on a cure. But BTI is just as I've had some good moments with them because they're also just as bad as MO when it comes to trying to market those vapes back in the day, because they got their vape advertised on a Formula One race car during a race, I think in Italy or something. And the government freaked out about it because you're not supposed to advertise any tobacco products in that aspect of it. But I think on a touch on MO as well, man, they're doing real well. I noticed you briefly mentioned it, but they've seen a huge increase in their, what are they called? The things you chew on. I don't do chewing tobacco, but they're not, it's not like chewing spitting. They almost look like little tea bags, I guess, you suck on.
Snuffs?
Yeah, I guess that's what they're called. But yeah, overall, man, the only thing I got to worry about with MO right now is you see that big shift going toward vaping, but they're having that lawsuit where the government wants to shut them down, right, and kind of sever them off from it because they think they purchased it in some weird way. I can't remember.
Right.
But yeah, man, I don't know. It's been pretty good earnings all in all, and I can't really complain other than it looked like it was going to be the greatest next day ever, followed by a wicked crash. But it's better now, I guess. Trying to get some investments going. We see what happens.
I agree with you 100%.
But yeah, you caught. Have you touched base on Buffett's meeting yet? And I noticed you didn't.
I haven't. So if you don't mind, can you just how much of it did you watch?
Oh, all of it. I was gonna make a whole video on it, and then when I realized I had like 4 hours of footage, I decided to cut out like 5 questions I liked.
Yeah, if you don't mind, I'm gonna. My phone is running a little bit low. I gotta go get my charger. So I'll let you kind of get after it for a minute, and then I'll kind of just I'm not gonna hop off, but I'll kind of just let you run it and talk about it, give a brief rundown if you want, and I'm gonna be right back.
All right, Matt's gonna trust me with the live stream. He's putting a lot of faith in me here, ladies and gents. Oh, he went right off too. It's just me. Hey, all right. So what's going on, guys? Welcome to the Map Money live stream, now redirected by passive income investor in the Great White North. And yeah, so we were just watching the Warren Buffett. Excuse me here. It's pretty late. I've had a long day, but nonetheless, I would love to know what you guys think if you caught up on the Warren Buffett Berkshire meeting there. They had they did the whole highlights. I broke down some of my favorite questions. We had some Delta airline questions in there now that Warren Buffett finally admitted that he just doesn't like the airlines. But I think Matt touched base on some of that. So yeah, if this feels kind of like a radio show, a late night radio show, because I'm not even got my face up in here. Literally just about to go to bed. Yeah, so what's going on, guys? Throw some questions in here. You'll have to go watch my video. I might as well just plug myself. Yeah, go watch my Buffett video, guys. It was about 4 hours. I cut it down into about 15 minutes of just 4 questions. That was a pretty long. Forgot how long Buffett could go for. Charlie Munger wasn't there, though. It kind of sucked. I wonder how much Warren lost. Warren lost a pretty decent chunk of change. I found he touched base on a lot of good comments, too. About like his cash position, because everyone thinks he has a lot of cash, but they don't realize like the companies he owns that don't show up on that annual report in the aspect of not the stocks. So I mean, he's got a little less cash than I think people think. I'll have to check it out. Yeah, you should definitely check out the annual meeting. It was probably one of the more fascinating ones. It's definitely going to be a historical moment, I think, considering there was a big buildup with those airlines and those questions, and it was crazy for him to just come out and just be like, yeah, we made a mistake. Look, airlines, they're just going to keep making planes. It's going to get more diluted. We already have all them, this debt they're taking on. God knows how long it's going to take to pay off. Is that Kyle money? Yeah, it should be called Kyle money here, or passive money maybe. I don't know. Too bad I can't throw up. I don't think I can throw up. I don't think I have the seniority to start throwing up your questions on the stream. Matt's putting a lot of faith in me here this evening, ladies and gentlemen. It's a very unique way to construct your portfolio. Sorry, I'm just reading through some of your questions. You guys need to throw me something here before I run out of ideas for you. What else is going on in the news? Did you guys catch any really good earnings? We got a few more coming up on the Canadian side of the border this week. We got the Canadian banks. We got some of the real estate coming out, which is also going to be a really interesting topic that Warren touched on. Was just this a lot of inconclusive answers around real estate. But we got Matt back here. But when it comes to real estate, man, I made that Kevin O'Leary video where he was really beating it up because he said they were going to even try and cut back on using office and retail space. But I still think to a good extent, the economy is going to come back to like somewhat of a normality because we're all getting cooped up. And to say like, oh, everything's just going to flip and, everyone's going to just start staying home and not doing certain things and working from home to an extent for sure. Matt, it wasn't the most thrilling since you've been gone, but it's still good.
I heard you. I heard you chirping up, man. You sounded like I heard we're having to change the name of the channel and everything.
It's not a good idea to throw the live stream over to me at 1:30 in the morning here, bro. I was literally going to go to bed other than people were like, oh, Kyle should hop on, but this is going to be like my least professional.
Yeah, I'm hoping I got my phone plugged in, but I'm hoping it doesn't drop out on me because
I think it dropped out on you.
Well, no. I know it did.
You're back.
I turned it off, but I know for a moment, if I have it plugged in, even if it's like plugged in, the camera sometimes might take up more energy than expected. So my phone still might die. So hopefully that doesn't happen.
Yeah, that's all good either way. Yeah, I don't know. What do you want to talk about? What do we got going on, guys? What else?
Yeah, I'm curious. We can walk through. So curious what your thought is, because I kind of walked through with this gentleman earlier. What would I invest in with $400 or so? What would you personally do? And kind of keep in mind, you might have missed it. So this gentleman was talking. He was kind of investing around 20% of his salary, some of which is in 401k, and then he's investing a decent bit into ETFs as well. But he's starting to try to get into individual stocks. And so
$400. I would have bought Tesla 2 weeks ago when it dropped down to that 350, 400 range.
Yeah.
I don't know. $400 is hard, unless you want to go down that M1 path. But I can only tell you what I did, man. I can't tell you what's good for you. But when I started out with $400 or $500, I only ever owned 1 or 2 stocks. And I know most people don't agree with that aspect of it, but yeah, that's just what I did with that small amount of money. Worked out well over the long run as a build, but yeah, man, I don't know. I don't want to be too blunt either. Is the video lagging out on you guys? Because on my computer here, when I'm watching the stream as well, it's kind of laggery. Kind of kicking in and out. Maybe it's just the computer. Who knows? If I sound dodgy, it's because I'm using my internet instead of my LTE.
Is it me or is it?
No, I don't know. I'm watching it on. Yeah, everyone says it's lagging, but I'm sure they can hear us. It might just be the video that's lagging out for some reason. Connection problem. Too many people streaming porn, apparently. Video restart combo. I wonder if they can hear us. Hey, just give us a thumbs up if you can hear us, even though the video is lagging. Any thumbs up out there? It's Matt's internet. Give us a thumbs up if you can hear us, even though the video is lagging. I don't even know.
It could be that South American internet.
You goes broke know. YouTube. I think we're losing people. Lagging in and out. I don't know. You might. I guess you can't easily restart it. The audio is lagging as well.
Can hear you, but not when the video is paused. Oh, okay. I don't know. Yeah, I don't know what's going on here, but.
You sound good to me though through the back.
Yeah, you sound clear as day to me as well. So I don't know if it's or I don't know what it is. I don't know if it's YouTube or what.
Well, we're trying to get you to this 4-hour point so you can catch up to Buffett's time. We're about 20 minutes out. You guys broke YouTube. Now it's going again. All right, we're back, ladies and gentlemen. Welcome. We were talking about what? The $400 investment, right? What are we buying with $400, folks? Let us know. What would be the $400 investment to turn everything around?
So what were some interesting conversations you guys were having in the chat? Because I kind of just went off for like 3-4 hours and we're just concentrating on the 2-3 people that came in. So.
Yeah, sorry. I'm just watching, reading some of the comments now, but I think we might be lagging out again. I can't tell. You're kind of in and out, but yeah, 400 every month. Yeah, I figured you would be doing 400 every month because it's always such an interesting question when everyone's just like, "Oh, you got 500, you got $1,000 to invest," and it's just like, "Yeah, but what about next month and the month after that?"
Yeah,
I mean, keep diversifying and building, brother. I mean, if you can do 400 a month, what I typically do with my girlfriend right now is. We try and invest at least in lump sums to that amount, or if not more. I don't try and do less investments unless I'm getting real, like over the last few months with the lack of income I've had, I've been investing way smaller amounts, like 100 to 200. But yeah, here we got Microsoft, J&J, Canopy, and my M1 Pi. Canopy is going to be real interesting to see how that ends up playing out. I'm still keeping an eyeball on that. It would have been fun to pick up when the MJ sector took that big beating as well. And now my girlfriend is apparently watching this because she's texting me as well. I don't know how she ends up finding her way on here. Do you have any questions? Now she can comment through the text because I can see it on my phone. She doesn't comment on the chat, but she should send me a text and we can answer her questions while we're sitting here as well.
Is she, does she have a YouTube name or not?
I do not know. That would be a good question. That's how.
I was curious because there are some folks that like follow you that I think that she may or may not be, but I don't know. Obviously, if you would know at that point if she did, because they talk to you directly. So obviously, it's not her.
Yeah, no, I don't know. I don't. It's kind of a shame, really, that I don't know what her actual YouTube name would be. She's still texting me.
Subscribe to either of our channels? That's the real question.
Well, she definitely watches more than I probably do because she's the one chiming in after I leave the Independent. So, but yeah, man, it's getting late. I still want to push that 4-hour mark for you, but I don't know. Our market's gonna rally again or go down lag. Let's hope they go down lag. as much as I love seeing my portfolio hit like highs again coming into this year, I would love for it to further go down. I mean, there's still good sectors that I think are cheap, but at the same time, man, I want these like AAA rated stocks to come down, like your Cloroxes of the world, like those stocks that just never come down. That would be like epic awesome to own,
100%.
especially at times like this. But you're always going to pay a premium. But on the utility aspect, I'm surprised how many renewables are there even? I don't know. I know there's Brookfield renewables. I found that to be a pretty interesting topic when you guys were talking about it.
I don't know all of them, but I'd say the big ones that do a pretty good job that I know of are Brookfield does a good job, Duke does a good job, Dominion's doing a little bit more on the LNG side than I'd say most. I don't know what kind of Dominion is doing in terms of renewables. Southern Company is doing pretty well. NextEra is doing pretty well as well with renewables. And then some of these oil companies, man, I don't think people give them enough credit of how decent some of their renewables portfolios are, but they're pretty significant. Bigger than I would say, most, if not competing with some of those companies I just mentioned. And Berkshire Hathaway Energy is also a huge solar renewables provider as well. So if you're really into solar, I think that an investment in Berkshire Hathaway could also be a pretty good idea as well. And you get a bunch of diversification with other things from Berkshire Hathaway as well. But
yeah, Burke's good, but it was interesting listening to the comments too when people were asking him about him underperforming against the S&P 500 lately, and just some of these investments and how they're shuffling money around. But yeah, a lot of people are curious what the markets are going to be doing here. Will the market spike? Will it be down?
So I want to touch on that one because I grabbed some munchies as well. But a lot of people. So I'm not going to pull like the Warren Buffett and not eat or drink anything in 4 hours. I'm going to eat and drink a little bit. But a lot of people talk about that. But Warren is investing on a different wavelength than I think a lot of people. Warren is making sure that he doesn't lose anybody money. So a lot like some of these hedge fund managers, they're investing to make sure that in times of bad, like we're seeing now, they still have an extremely robust portfolio that they can rely upon that provides cash flow to the business. So, and I can understand where he's coming from because the way that he looks at it, he's been operating Berkshire Hathaway like a big hedge fund for a very long time. And so times when there might be huge economic boom, when there's huge economic boom, that means people are generally speaking taking on a lot of debt, using that debt to leverage themselves. And when people are leveraging themselves, they can then expand rather quickly. But then it gets to the point where there's economic slowdown, and that debt now becomes a liability like it always has been on the balance sheet. And when things get bad like they are at the moment, that liability is now obviously hindering the performance of the business in the terms of having interest payments that are due, not having enough cash because people have been investing too heavily. And so what I think that Warren does is he definitely balances the two. Is he too conservative? Maybe.
I think Warren's too big, man. He's too big these days. It's just I don't think he's going to get the growth that they once had in the past. I think they're really trying to do it with Apple and whatnot. But I think honestly, if you really enjoy like the way Buffett is investing and you want that kind of exposure, I think we should go back to that conversation we had about like buying ETFs. Nothing wrong with ETFs. Buffett keeps saying that as well. But at the same time, like this is such a good opportunity to buy like those individual stocks out of the ETF that are overperforming. And I keep thinking of people like PPCE and like even Buffett now pulling out of those stocks that are no longer considered safe, like the airlines. That I think it's touching base on something really good. That if you wanted to build like a super structured, solid portfolio, just listen to these investors. Like I found it really interesting that now that people are getting a little bit more fearful, they're pulling back on their fundamentals and going more for those core solid holdings, even if they have to pay premiums to get into them. So I mean, it's if there's anything good going on right now, crazy. Sorry.
You mean the Johnson and Johnsons and the Cloroxes of the world, or?
Yeah, well, I look at even if you bought most of them, you're still doing. They're still going up, right?
Right.
So I mean, you're not doing bad. I love owning them. I'd love to get into some of them again, but I don't know. I'm always flip flopping around on different stuff. But I just think it's interesting because I don't know if you watched PPC lately. I got to watch his more recent video, but I found that last one he posted about pulling all his money and trying to focus more on his ride or die stocks. Yeah, I need to go watch PPC's video. It looks like he posted a pretty interesting one. I kind of skipped the beginning of it, and then I faded out to do some stuff, and then I didn't come back to it. But yeah, it seemed very aggressive, which he doesn't seem like much of an aggressive guy.
Aggressive against dividends or for dividends?
Oh, he's always aggressive for dividends. I don't know what it was about. I think I don't know. I'd have to go watch it. Somebody could probably let us know in the comment section below. We're missing out on drama here, boys. Got to catch us up on the drama of the YouTube world.
Yeah, I definitely enjoy PPC Ian, and I'm actually part of his Facebook group as well. It's very interesting. It's kind of like our WhatsApp group, right? Where you and I will say one thing, and then, and you and I talked about this on the phone a little bit earlier, where you have people that are like watching the channel and hearing how I invest, and so you think that because they subscribe that they might have a similar idea as to what their investing strategy may be like, and if they didn't, then they would go find somebody that maybe resonates with their investing strategy, and then they would subscribe to them. But you have like these 3,000 to 4,000 people that are in PPC Ian's like Facebook group, and all they talk about all the time is like selling and like how they're selling out of stock, and like they're down 50%, so they're just going to sell, or like, you know what I mean? Like they got in it last week and they're down 5%. Should they sell? And I'm like, I thought I'm just confused because like I feel like PPC Ian and Ryan, you and me, we kind of preach the good preach and preach the good word. But then when it gets to like anything happening with their portfolio, they just like take it, throw it out the window. And I understand not everyone follows the same investing strategy, but it's like, and I had a good conversation with my friend the other day, and I was just like, and I told you this about this earlier, where I was just like, yeah, man, like do this, do that. If you want to invest, like you have a long-term horizon, you want to do dividends, and then I have a conversation. I was like, hey, like, we had a good conversation. Did you buy anything? And they're like, yeah, I bought this, this, and this. And I'm like, how did you take anything that you agreed with last week when we had a good conversation and just like completely ignore it and buy like the most risky stocks of all time? So I just find it very, very interesting.
Yeah, we touched base on that. It was pretty funny because it just comes to the same fact of like when I physically invest for other people, they seem to do fine. But when I advise them on like what I'm kind of doing and then kind of how I would recommend doing it, they go ahead and they'll just purchase something either I've never owned and it's just because I've shown them those kind of stocks that are high yielding. I don't know. It's hard to tell people to get into safe stuff. I should do an update because I still have my port. I don't know if people remember the Portuguese monkey joke that I was running for a while, but I still have this portfolio that I set up just before the crash. I never came back to it, but I've been watching it to see if it comes back anytime soon. I picked those top 10 companies from the S&P 500. I still think they're going to do crazy, but I've been kind of keeping an eyeball every now and again to see what's up with that. But
so are you doing better than them, or is it still off?
Oh, and I bought them right at the top, bro. when I made that 100K portfolio out of the top 10 companies, it was right at the top. But I still think it's gonna do fine. I'm not like worried about it at all. I just haven't updated it because it's kind of just this fake portfolio that I check in on once in a while. Actually,
I like those videos.
Let me look at it now. Actually, while I'm sitting here, how do I go to these account details? I think we're down about $15,000. All right, and the only one that is green, of course, is Amazon. So if you bought at the all-time highs like I did, you're only down 10%. Crazy.
Okay.
So you would actually still be outperforming, I think, the S&P 500 then, wouldn't you? Let me take a look.
I think so.
What's the Vanguard here trading at right now? Let me take a look. So if my portfolio I made just before the crash is now only down 10%, yes, you are actually outperforming the VOO by 6%. If you bought the S&P top 10 just before it crashed.
Can you do it?
There you go. Solid portfolio. Mine, I do not know yet. I'm curious to see what my my percentages are this month. Actually, I wonder if I can check that while I'm sitting here too. That'd be a good question. I don't know if the data came in yet.
I'm doing comparison here, so let's look at the last 3 months, and then
I wish I could pull this up for people to see, but let's take a look.
what do you want me to? You mean your specific?
Yeah, on mine, I can't throw it in, and no, I don't even think I have. Oh no, I think I have April's data. Let me throw my data up
This is
against
the past 3 months on the screen, looking at the S&P 500 versus what's IXIC? Is that the S&P?
Well, my TFSA is severely outperforming the S&P still. I just I clocked up. I'm sitting on about a 73.84% return against the S&P's 20% return since 2017.
Because you're a game changer, man.
Yes, that's not doing bad. I'm curious to see my RSP though, because Tesla's in there, and I feel like that account was just ridiculous because of that stock. But let's take a look. I'll have to do a portfolio update here soon. Oh yeah, like I'm. What is my RSP at here? My RSP is up 100%, 100.78%. So that's interesting. I did not expect to see that right now. I thought it would have been down, but I don't understand why it's up so much. That's weird. Well, not complaining. My regular managed account is up 81%, and so far my largest account is the one that's lagging the most. But either way, not complaining. Overall, from this entire record, I think the S&P says it's up 45%. If I didn't miss that. Sorry, I hope we're not boring people here. This isn't like the most probably interesting conversation here.
How many?
Oh, you got yours up there. Holy, I didn't even notice.
Oh yeah.
All right, you got iShares, the S&P 500. I'll be buying. Yeah, man, Microsoft is amazing. It was so laggard for the longest time. When the iPhone started coming out and that horrible CEO, and then they had a crazy turnaround ever since this new CEO popped in. What's his name? What's that guy's name? Yeah. That guy's done unreal work. He's like the new Steve Jobs, in my opinion.
Yeah. Because I had shares. Unfortunately, I don't want to tell this story, but I had shares of Microsoft in 2015 for like $56. I think I had 20 shares, and unfortunately, I sold. So around the same time, I think I bought shares of Facebook for $75. So just goes to show that sometimes never selling is a good strategy, and even some of us make mistakes. So unfortunately, yeah, I would be up pretty significantly if I still had my Facebook and Microsoft shares.
Yeah, I love. I want to almost lever down in my Microsoft and Apple, but every time they do, I'm shocked that they're doing dividend increases as high. Well, they're not like super huge, but I'm getting over 2% on Microsoft, and I think I'm just touching 2% on Apple, and that's pretty much the only thing that's keeping me from selling them right now. But I was buying Microsoft, I think when it was 103 or something.
Oh, wow.
Yeah, I'm still holding a decent chunk, man. I think Microsoft and Apple make up probably a good 15 or 20% of my entire portfolio. Because I think they're pretty massive positions. I think I was telling you before, I used to have like $20,000 or $30,000 sitting in Apple, and I wish I kept it. But I was just getting too worried because that's back during the tariff war when Apple had that first big dip. And
Right.
I mean, that was a big mood swing for one stock. I don't like having those averages. I mean, the risk reward would have been way better off, but that was the first time I think I got freaked out when I watched when you watch like a 20, 25K position drop by like 20 or 30%. I don't mind if it happens. Like I said, overall, not a big deal. But when it happens on something that large all at once, it kind of gets a little bit more worrisome. My stomach starts tightening up. I start feeling my risk tolerance levels.
No, I agree. It makes complete sense. I mean, if you're over leveraged in that sort of organization and portfolio balance, I mean, high risk, high reward, though, right? I mean,
yeah.
Like you mentioned, I mean, looking back on it, might have been better off because it would have went from 200 to 300. Because I mean, what you're talking about is when it went from 200 to 220 down to 130 and then back up, right?
I don't know if it might have went as slow as 130. I think it hit the 170 area or something.
Okay.
But yeah, that was when I think it hit a high of 220, and then it just plummeted back down to, you might be right, somewhere down there. It was, I think.
Okay, I didn't realize you had it all that had that high of a portfolio allocation as of that recently.
Yeah, it wasn't too long ago. I mean, we've both been refining our portfolios for a while. I just want to start building the positions up I have, and then start using those dividends to build up some new ones. Because the whole purpose